Hello, everyone, and a very warm welcome to the complete stock market investing course from beginner to confident investor. My name is Harsh Gupta, and I'll be your instructor. I'm so glad you are here. First off, I just want to say a huge thank you for enrolling. By joining this course, you are already one step ahead. You have taken the single most important step on your investing journey. You have decided to get started, and I'm honored to be your guide through this exciting process. So, I'm Harsh Gupta, and my passion is to make investing simple and accessible, and it is achievable for everyone, regardless of their background or the starting point. I have been involved in stock market for the past 6 years and navigating bull markets, bear markets, and everything in between. I've seen COVID and the dip, the crash, the bull run, everything. Now, my promise here is that I will be breaking down all the complex concepts into bite-sized practical lessons that you can apply immediately to build your wealth. Now, let us see who is this course for. So, it is for complete beginners, no prior experience needed. You just need the will to learn. So, for the confused and the intimidated, does the stock market feel like a mysterious club with its own secret language? So, we will be, making everything easy and making you understand everything. So, if you have heard about stock market and you have found it intimidating, you are in the right place. This course is designed specially for anyone who wants to build long-term wealth but isn't sure how to begin. So, for future wealth builders and smart savers, this course is perfect for all beginners to advanced because we will be covering all the topics in this from basic to advanced topics in the stock market. So, now let us see what you will achieve. So, from zero to hero, you will transform from someone who knows nothing about stocks to confidently analyzing companies, understanding financial reports, and making informed investment decisions. You can also build your strategy. You could craft a personalized investment plan perfectly tailored to your unique goals, risk tolerance, and timeline, not someone else template. So, every person has its own journey, has its own goals. So, according to that, you can invest whatever the amount should be, how much risk you are willing to take, and everything. So you also have to master risk management since stock market is not always, uh, you know, it's not a money printing machine, and people don't always make profit. Some people make loss too. So we have to, understand risk management, and we have to then command the tools. We will be helping you to open your brokerage account, navigating trading platforms, place your first trades, and monitor your portfolio with complete confidence and ease. So our journey together, let us see how is the course structured. So part one is building your foundation. The foundation section, first to third. We'll start with the fundamentals, why investing matters, how the stock market actually works, and getting all your essential tools and accounts set up properly. Now, the section 4 to 6 belongs to the analyst toolkit. Now, this is the time where will be deep diving. We will explore both fundamental analysis and technical analysis. So, fundamental analysis basically means understanding company value, how the company is valued, and how much it's its profit or something. Technical analysis refers to reading charts and patterns if you have seen those stock market charts. Now, part 2 will be mastery and application. So, from section 7 to 9, we will be doing strategy and mindset. So, we'll build on that foundation. So, you'll build your personal investment strategy, learn advanced risk management techniques, and master psychological aspects that separate successful investors from the rest. So, you must have heard a lot of people make losses. So, we will be understanding how you can maximize your profits in the stock market and minimize your loss. Now, we will be also seeing some real world applications in section 10 and 11. This is where theory meets practice, and this is going to be the most important section. And you will be seeing all the practical details how you can do that. Now, my teaching philosophy, how do I teach? My approach to teaching is very straightforward. First, no jargon. I'll break down every complex term into simple English. Second, this is practical course. So we'll focus on real world skills you can use right away. And finally, about the empowerment. My goal isn't to tell you what to invest in, but to give you the confidence to make your own informed decisions. So, what you will need some basic technology, a computer or a smartphone with a reliable internet connection. That's the only hardware requirement which almost everyone has it today in the world. Also, you need an open mind, being curious, and you must have some willingness to learn, readiness to challenge your assumptions about money and investing. That's it. No expensive software, no financial background, nothing. You don't need a lot of capital, etc., etc. I'll be covering everything. So the capstone project, so your $10,000 mock portfolio. So this is, you could instead of putting your real money first into the stock market, and you can use paper money to test whether you are making profits or not, and how is your strategy going. You can back test it and see if you are able, what you ever have learned, or if whatever you are thinking to do. So first you can test it whether it is profitable or not by using paper money. Now you can apply everything you have learned, right? So, and then you will build unshakable confidence. Now, how to get the most out of this course? To really succeed, I encourage you to be an active learner, take notes, pause the video to think, and most importantly, use the Q&A section. There are no dumb questions here. If you are wondering about something, chances are someone else's too. Remember that this is a skill that takes time to develop, so be patient with yourself. Now, this is a quick disclaimer. This course is for educational purposes only, and I'm not a registered financial advisor. And nothing in this course will be considered as financial advice. The goal is to teach you to do your own research. Investing involves risk, so never invest more than you are willing to lose. Now, are you ready to begin? I am genuinely excited, and let's dive in. Let's go. So, I'll meet you in the next lecture, and we will be starting our course. Thank you. Welcome back. In this lecture, we are going to answer the most fundamental question of all: why should you even bother investing? We'll explore how to make your money work for you and uncover the incredible power of compounding. So, let us first understand the problem with just saving. So, you work hard for your money, putting in long hours and effort to earn every rupee. But here's the uncomfortable truth. Whilst you're working, what does your money do? In traditional savings account, it mostly sits idle, earning a minimal interest that barely keeps pace with rising cost. The silent enemy lurking in the background, inflation. The rate at which money loses its purchasing power. For example, you must be, wondering what is inflation. So let us understand what is inflation. So do you remember paying 50 rupees for a coffee 10 years ago? Today that same coffee costs 150 rupees or most more. That's inflation at work. So you lose purchasing power. So for example, if you have 50 rupees 10 years back, so you could get one coffee. But if you kept holding that 50 rupees, and today if you go in the market, you won't get any coffee. So this is how you lose your purchasing power. So you're effectively losing money each year. So now to beat inflation, what you could do, the goal isn't just to preserve your money, it is to grow faster than the inflation needed. For example, if the inflation is at 6%, so you just don't need to get interest rate of 6% so that you just beat inflation. Why should you should earn 10% on your money or 15% through your stock market. This is the reasonable percentage that you can earn, 10 to 15%. Don't go like you'll earn 50% or 100% of your capital very quickly. Then you are for sure going to make losses. So saving versus investing, let us understand that. This brings us to a key distinction, right? Saving versus investing. So the primary goal of saving is that short term security and liquidity, and for investing the primary goal is long term wealth, growth, and financial freedom. So, saving is best for some emergency fund like 3 to 6 months of expenses or upcoming purchases like a car down payment or something like that. But investing, you need to think long for investing. You need to think big for investing. It is for retirement planning, building generational wealth, major life goals. Now, in saving, the risk level is very low. Your principal is protected all the time. When you save, you put money in your fixed deposits or something like that in the bank. So your money is fixed. But in investing, the risk is a little bit higher, but it is manageable with proper strategy. If you study properly, you have a proper strategy, then investing has you can minimize this risk and make more profits than savings. So the returns are minimal, often below the inflation rate. So you end up losing money when you put in the bank, because if you see inflation, the basically um, we get the data, the inflation is around 6 to 7%, but it's not true, because majority of our expenses where we spend our money, that is around 10%. The inflation is 10% over there. So the data which we get is 6 to 7%. That's not true. So we need to do investing for returns, and we'll also see how compounding works and how will your money work for you. So the solution is that let your money work for you. You put your money to work. Investing is like hiring your money to go out and earn more. So you also become a part owner. When you invest, you become a stakeholder in a successful business and their growth journey. And you could also share in the success. When these company grow and profit, your investment grows with them. That's the beauty of ownership, right? So don't worry, we'll be understanding how everything works. So Albert Einstein supposedly called the eighth wonder of the world is compound interest. So now what is compound interest? What is compounding? So compounding is interest earning interest. It's the secret sauce that transforms modest savings into substantial wealth over time. So here's how the magic works. For example, you have, let's say, you have 100 rupees, right? Now, if you are earning, let's say, 10% um, return per year. So if I add 10% to it, that will be what? You'll get 110 rupees, right? Now, next year, what will happen? Next year, you're assuming again we will get 10%. The interest rate is same for all the subsequent years. So now what will happen? You'll be thinking, just add 10 rupees more, it will be 120. No, it will not be 120. Now what will happen? We have to add in this 110 plus 10%. So 10% of 110 is 11. So now we will be having 121 rupees, right? Now if I, go further, so 121 plus 10%. So the 10% of this is how much? It is 12.1. So if I add 12.1 to 121, that will be 133.1, right? This is how compounding works. And you'll be thinking it's just 2 or 3 rupees more. No. But when you take this down to like, you know, 10 to 20 years, you'll see that um, this rises exponentially. We'll see some example. So this process repeats and creating a accelerating snowball effect that grows exponentially. So have you seen a snowball like this? So what happens is that it starts with a small snowball, and then while it is keep rotating, coming down the hill, so it collects more snow and it becomes a big snowball. So this is how it works. So we have also taken an example over here. 1,000 rupees grows to 1,100 rupees. You earn 100 rupees in the first year, and then in second year your 1,100 grows to 1,210. You earn 110 rupees. Now your 1,210, you know um, go increases to 133 point 1,331 rupees. You earn 121. So first year you were earning 100, then you earned 110, then you earned 121. So this is how your interest keep on growing. So you are basically earning interest on interest. Whatever the amount you got as interest, next year you are earning interest on that interest. So this like increases exponentially. So now let's see how the snowball gets bigger. So for example, the initial 1000 rupees to over 45,000 rupees in 40 years. So that's 45x return. So basically what happens, if you have here, you can see we have invested just 1000 rupees over here, right? And then after 20 years, 30 years, if you calculate this, so this will be how much? This will be 45,000 rupees. So from here to here in 40 years, and you did nothing, you just put your money to work, that returns like 10%. So in 40 years, you made 45x amount. So basically, in compounding, is that first year it will not double your money or something like that, but it will compound. So this is how compounding works, and you could make money like this. So now meet two friends, Ben and Arthur. So let us see the Ben's strategy and Arthur's strategy. So from age 25 to 35, he invests 200 per month consistently. And from 35 to 65, he stops investing and let the money grow. So total invested was how much? 24,000 in 10 years. 200 per month means 200 per month means in a year he will have deposited 2400 rupees, and in 10 years he will have 24,000. He has invested 24,000, right? Now Athos strategy is that from age 25 to 35 he doesn't invest anything, and from 35 when he grew up and he understood the power of compounding and investing at a later stage in life, somewhere near midlife. So now if he invests 200 per month for like 30 years, so in 1 year they're investing 2400, so author is investing 72,000 over 30 years. So what do you think, who will have more money at the age 65? The answer might surprise you. He has invested over only 24,000 for 10 years, and he has invested 72,000 later, but later, 10 years later, but for 30 years. So, what do you think? Let us see the results. The results might surprise you. So, the surprising result is that he invested for 10 years and he will have more than 10 lakh rupees, more than a million. And for 30 years, when he invested, so that will be only 4.4 lakh rupees. So, why? Ben invested 24,000 and ended up with more than twice what Arthur achieved by investing 72,000. Starting early is your biggest advantage. Time in the market beats timings in the market. So this is a deep link. Time is more important than the timing. So it doesn't matter whether you are putting money in a crash or when the stock prices went down. It's important if you invest early. So if you invest early in life, so you will make more money because of the compounding, the snowball effect, which I told you. So this is how it works. So if you are young, so even if it is a small amount, start investing today. Now, there are two levers of compounding. So you have complete control over the two powerful variables that determine your wealth building success. So the first is time. How long you stay invested matters. Every year you wait is exponential growth you are giving up. The best day to start was yesterday. The second best day is today. You must remember this. The best day to start was yesterday, but the second best day is to start is today. Start investing now, even with small amounts. Stay invested through the markets up and down. Don't pull out your money or pull in the money. Just make fixed payments like for every month or annually or quarterly, whatever your budget allows, and let time work its compounding magic. If you must have studied the compound interest formula, that is amount is equal to principal 1 plus rate of interest divided by 100 to the power t. So you can use this and calculate. Second, what matters is that contribution. Consistency matters. How much you invest regularly accelerates your growth. Even small, consistent contribution add up significantly over time thanks to compounding. So you can automate monthly investment to build discipline. You can also increase contributions as your income grows. So you must, like, if you're getting an increment or you're making more profits in the business, you must increase your amount too. Now remember, something is always better than nothing. Now the key takeaways from this lecture is that savings aren't enough. Inflation will beat your savings and you'll lose purchasing power. Investing creates wealth. Investing lets your money actively work for you, generating returns that compound over time and build real wealth. And the third takeaway is that compounding is your engine. Compound growth is faster. Compound growth is the fundamental engine of wealth creation. Einstein's eighth wonder that transforms modest investments into substantial wealth. Start today. Remember, the best time was yesterday, and the second best time is today. So next up, what to invest in and you know why. Also, we'll be learning what are stocks, what how does a share work, what is the company valuation, what are index funds, and how you can do everything. Don't worry, the first section is just introduction and me convincing you why should you invest and invest early in life, and what will be the things if you invest early or not. So this is how it works, and I'll see you in the next lecture. Thank you. Welcome back. Now that we understand why we should invest, now it is time to learn what we can invest in. In this lecture, we are going to break down the three big fundamental building blocks. So, the big three asset classes: stocks, bonds, and mutual funds. Your essential building blocks for constructing a resilient investment portfolio. So, what is an asset class? Before we dive in, let's clarify a term you hear a lot: asset class. You can just think of asset class as different buckets for your investment. Each bucket, like stocks or bonds, has its own unique characteristics, own level of risk, and own potential for reward. Understanding these is a key to build a balanced portfolio, right? So we'll be exploring these three main asset class. So stocks, which is also known as equities, this is ownership in companies. Bonds, that is fixed income, that is loan to entities. And mutual funds and ETFs, they are diversified baskets. So we will be understanding all the three asset classes. Now let us begin with asset one, that is stocks, and that is equity. So what is a stock? A stock is a stock represents a share of ownership in a company. If a company issues 1 million shares and you own one share, so you own 1 millionth net of that company. So stocks are also known as shares or equities in the investment world. For example, you have Apple stock, Amazon stock, Tesla stock, Microsoft stock. All the big companies that are public have their own stocks. So why own stocks? So basically what happens is that for capital appreciation. So first we need to understand the valuation of a company. How does the valuation of a company work, right? So let us first understand how the valuation works. So what is valuation? So basically, for example, what happens is that, for example, there is a company that company does, let's say, 100 rupees profit per year, right? Let's say, let's leave profit for a while. Let's talk about revenue. Let's say a company sells, let's say, for 10 lakh. The revenue of a company is 10 lakh. So basically, they are selling something, and total amount they sold in like 1 year, that is 10 lakh. 10 lakh per year. This is also known as ARR, that is annual revenue run rate, right? So how much revenue does the company does in 1 year? So for example, if they do 10 lakh in a year, so now what will happen? For different companies, we take different multiples. For example, if there is a D2C brand, D2C brand is something that direct to consumer. So for example, you are selling a chips packet, or something, you are selling the phone cases or something like that. Here what you are doing, you are producing your product, and you are selling for a margin of whatever that may be 10, 20, 30%. So for these companies, the valuation multiple is around 2 to 3x. So for example, they'll say if you do 10 lakh rupees revenue in 1 year, your company is valued at 30 lakhs. So if I want to buy your company, I'll pay around 30 lakh rupees. uh, this number can vary. So basically this number is properly calculated by chartered accountants. They do all the audits and the assets of the companies, the liabilities of the companies, and then they calculate what is the final valuation of the company. Now what happens is that for tech companies, because tech companies have usually have a very high margin and a very low asset cost, so these companies are nearly valued at 20x, 30x, or something like 40x. So let us say 20x. So for example, if a tech company is doing 10 lakh ARR, so this the valuation of this tech company will be 2 crores, right? Whereas a D2C brand will have lower valuation. So now what will happen? So this is how the valuation works. So for example, this tech company, which does 10 lakh rupees revenue in a year, this has a valuation of 2 crore, and the owner of the company decided to split the company into like multiple shares. So for example, from this 2 crore, he created, let's say, he divided into 10 lakh shares. Now what will happen if he has divided this 2 crore? So if you divide 2 crore by 10 lakh shares, so that will be 20 rupees per share, right? So now it is 20 rupees per share. Now what will happen? Now here's the interesting image. Now if I buy this 20 rupees share right now, and I am predicting that this company will do great in future. So for example, if maybe a year later, 2 years later, now this company is doing around, now the ARR increased to, let's say, 50 lakh, right? Now this 50, if it is increased to 50 lakh the ARR, so this 2 CR will also be increased to how much? It will also be like 5 times. So now the company will be 10 crore. But the 10 lakh shares, this is fixed, this will not change. So since this is fixed, now the price of my share, which I bought at 20 rupees, will increase to 100 rupees. This generally does not happen. It does not, um, a company does not give you 5x return so quickly. I'm talking about initial stage of company. So for example, if you've invested in it, right, so don't expect like you'll buy a share of 20 rupees and it will be 100 rupees very quickly. It doesn't work like that. General returns you get like 15%, 20% in a year. That because that has very low risk. There are companies which give 2x, 3x returns, but the since the company's valuation is very volatile, so you might end up losing some money also. What if you bought at a higher price, you are expecting it will go further high, but it crashes? So we'll be investing in safe companies, and I'll tell you what are the blue chip companies and etc. Don't worry for now. So if I had bought at 20 rupees share, for example, maybe 2 years later, 3 years later, now my share price is 100 rupees. Now the 80 rupees I got as profit, right? So now this 80 rupees will have a capital gain tax. which you have to pay to the government. Each country has its own capital gain tax. So for example, in India right now we have 12.5%. uh, so have to pay whatever the tax is, and then we can keep all our profit. So this is how you can make money, and this is how the company valuation works, right? Now, we were talking why you should own stocks. So capital appreciation, the value of your share increases as the company succeeds and grows. You can buy low and sell high. That's a fundamental strategy for wealth creation through stocks, which I told you. Now there are some dividends also. For example, I told you this company is doing 10 lakhs rupees per year. For example, they might be, making some profit or losing some money to. These days startups work very differently. For example, this company is making, um let's say, 1 lakh rupees profit. ठीक है, 1 lakh rupees profit. So now what will happen if 1 lakh rupees is the profit? So it will be divided by 10 lakh shares, and it will be zero point 0.1 rupees dividend. So this will is dividend. So some companies share their profit too with the shareholders. So per share, what you will get dividend. So for example, if you own 100 of these shares, so you will get 10 rupees as dividend. So dividend is very low, but you also, many companies share profit with their shareholders. So these are the two things where you can earn money. First is capital appreciation, that the value of your stock will increase, and second is the dividend. So this is how you could work. Now the risk of stocks, the volatility. Stock prices can fluctuate significantly, sometimes rising dramatically, other times falling sharply. Market swings are a part of the equity investment landscape. Company performance risk. If a company performs poorly or faces bankruptcy, your shares could lose substantial value or become worthless. So, where the risk level is high, the reward potential is also higher. So, for example, if you, like COVID came, or if there is any recession or something like that, so the stock prices crash too, because these are very, volatile. So it also depends on market emotions, what people are thinking, whether people are investing in the stock market or not, whether many people are interested in buying or not, and if you are selling, there must be a buyer. Obviously these days there are so many people, there is always a buyer, but at what price you get. Now, so this was the stocks, this is the equity where majority people buy stocks, and they take. And stocks are also good because some stocks are very cheap and you can just buy one, and it doesn't have like, you just have to buy minimum one share. It's not like that you can have zero point 0.5 shares or something like that. New startups are coming these days which help you invest like zero point 0.5 share you can invest, so they have a lot of stocks, so, and a lot of users, so they generally divide the stock also, in case if the stock is valued at too high and it is likely unaffordable for normal people. So now if we talk about the bonds, which is fixed income, so you become the lender. A bond is essentially a loan you make to an entity, either a government or a corporation. You are the lender, they are the borrower. So regular interest payments. In return for your loan, the borrower promises you to pay regular interest, your payments called coupons. And principal is returned at maturity. So on a specific date, they return your original loan amount, the principal, and the interest you get regularly. So why own bonds? So for stability and predictable income, bonds are generally less volatile than stocks and provide a steady, predictable stream of income through interest payments. Also, you have this capital preservation. They are considered safer investments and are commonly used to balance the high risk of stocks in a diversified portfolio. So, all your investments must be diversified. It shouldn't be like, for example, if you are thinking AI is coming and you invested in artificial intelligence like all of your money. What happens if AI is a bubble and for the time being it crashes? Like the dot com bubble came, and if the AI bubble bursts, and so everything will go down, so you lose all your money. So it shouldn't be like that. You should always diversify your portfolio. So diversifying means putting like 20 to 25% into AI, and some of the amount in some other sector, and some of the amount in other sector. So for example, if the recession comes in a particular sector, you don't lose all of your money, you lose only a part of your money, which could be nullified with other profits. So the primary goal is income generation and safety of capital. So not, for generating income, we don't have to do like losing all your capital. So the risk of bond is that interest rate risk. When interest rate rises, newly issued bonds become more attractive with higher yields. Your existing lower rate bonds may fall in market value as a result. So the risk level is lower, but the reward potential is also lower. So there is also credit default risk, that the borrower, government or corporation you give money to, you lend money to, is not able to pay back. Then you lose the principal amount too. This doesn't generally does not happen. Government returns the principal amount, the money, and the corporation too. But just in case, you never know. So risk is there, but not so much. Now, stocks versus bonds. Let us understand with the car analogy. Stocks are the engines, stocks are like the gas pedals. They provide the power, speed, and acceleration for portfolio growth. They propel you towards your financial goals. Bonds are the brakes. Bonds are like the brakes. They provide safety, stability, and control when market gets bumpy. They help you slow down and protect your capital. So, a well functioning car, just like a good investment portfolio, needs both an engine and its brakes to reach the destination safely. So, in a car, you also need the engine, but you also need the brakes. If there are no brakes in the car, that car is useless. However, the fast that car is. Now, the problem is of just picking the one, as I told you. So, picking individual stocks and bonds require extensive research, analysis, and time commitment. You must study all the company reports, the fundamental analysis, technical analysis. What if you pick the wrong investment? Your risk becomes heavily concentrated in one company or entity. Market timing and selection expertise are difficult skills to master. Emotional decision making can, cloud judgment. So for this, we have asset number three, that is mutual funds and ETF. What are they? A mutual fund or ETF is a basket containing many different investments, stocks, bonds, or other assets, all bundled together. So they're professionally managed. These funds pool money from many investors to buy a diversified collection of securities managed by investment professionals. Right. So mutual funds basically, there's a basket. They buy a lot of stocks and they sell these small baskets to individuals. So individuals don't need to think of diversifying their portfolio or do the hard work. There are professional, there are investment bankers whose job is to put they study all the day, they do the research all the day, and then they invest money, that money somewhere, and then you get the return from there, and the profit is then shared. They might give you 10%, 12%, or something like that. It always varies. Sometimes they also lose money. It's not guaranteed that they'll, for sure there is no fixed return. Fixed return you only get through banks, which is the fixed deposit, and all the deposits. Wherever you try to earn more than the bank interest or something like that, or a massive jump in the interest rates or the profits, there will always be a risk. So you need to be careful. Now let us talk about the ETF difference. ETF is exchange traded fund, similar to a mutual fund in structure, but trades like a stock on exchange throughout the trading day. Now, why you should own mutual funds and ETF? As I told you, they have instant diversification. With a single purchase, you can own hundreds of or even thousands of different companies, spreading your risk across multiple investments. Professional management is there. Experienced fund managers and analysts are conducting research and making buy sell decisions on your behalf. Also, there is low entry barrier. You can get started with a very small amount of money, making investing accessible to nearly everyone. Now, let's take an example: the S&P 500 ETF. So, instead of trying to pick the single best company in America and hoping you are right, so what you can do, you can simply buy an S&P 500 ETF. The single investments give you a small ownership stake in the 500 largest companies in the United States, including giants like Apple, Microsoft, Amazon, Google, and hundreds of more. So you are diversified instantly. So the key takeaways from this lecture is that stocks is ownership in companies, high growth potential and higher risk profile. Bonds is what? Bonds is a loan to entities and you have income and stability. It has lower risk profile but lower returns too. There are some mutual funds and investments. These are basket of investments, instant diversification, simplicity and access. These three asset class are the fundamental building blocks we will be using. So next up we will be debunking investment myths. So in the world full of investing, of opinions, hot tips, market rumors and persistent myths can all derail the most well intentional investments. So in the next lecture we are going to debunk some of the most common and dangerous investing myths out there. So I'll see you over there. Thank you. Hello and welcome back. In the world of investing, there is a lot of noise. You hear things from friends on the news, on social media, and a lot of is just plain wrong. In this lecture, we are going to play with mythbusters. We will identify the most common and dangerous investing myths and bust them with facts. So, let us understand what are the myths and why they are dangerous. So, why is this so important? Why we have a separate lecture for just busting the myths? Because these myths are more than just harmless misunderstandings. They create fear, they cause confusion, and they can lead you make really bad financial decisions. Worst of all, they can paralyze and prevent you from getting started. So today our goal is simple: replace fear with facts. So we are going to you know burst all the myths. The number one myth, which is not true, that says that you need a lot of money to start investing. Trust me, this is not valid. Investing is only for the rich. You need thousands of dollars to even think about it. This is one of the most persistent and damaging myths in personal finance. It prevents millions of people from beginning their wealth building journey and making them believe that investing is some expensive club reserved for the wealthy elite, which is false. This belief is completely outdated and hasn't been true for years. So the myth is busted. You can start with even tiny amounts, whether it can be like 500 rupees, 100 rupees in some cases, right? So fractional shares revolution. Now, many companies like, for example, MRF, that stock is over 1 lakh. It is 1 lakh something. So it doesn't matter that you have 1 lakh or not. Even if you have 10,000 rupees or 1,000 rupees, you could get a fraction of that share. Many startups these days, they are providing this. There are also ETFs and mutual funds, which I told you, that is a basket. So basically you only have fraction of particular shares invested in various sectors. So this is how you can invest in this. So this is a myth that you need a lot of money. So this is not true. Someone who starts with 1,000 rupees today will be far ahead who someone waits years to save 50,000. We have already seen the case and we have already done our calculations. You know that this is false. Now, talking about the myth two, investing is basically gambling. The stock market is just, a big casino or something like that. So when you bet on stocks going up or down, this myth is also not true, because it doesn't happen. It's like that. This comparison is one of the most damaging myths out there. So gambling is what? It is a losing game. It is based on pure luck and chance. There are no underlying value creation. The odds are mathematically stacked against you. If you ever check the um, odds of gambling, so you get a lot less when you win, but you lose more. So there, that is no productive activity, and it's a zero sum game. Your win is someone else's loss. Investing is basically building wealth. It is based on research, analysis, and business fundamentals. See, if you put your brain into investing, and you do all the research and properly invest somewhere, then it is investing. And if you just randomly pick any stock, or you just buy something, sell at something without using your brain, so that will be nothing. That will be close to gambling. So that's why you are here in this course, and we will be learning how to invest carefully, since it involves risk. So how you should invest carefully over here. So wealth is created, not just transferred. Now, myth three is that you have to be a genius or an expert to invest. Even if you don't know like basic things, just put your money into index fund or something. I'll be teaching you everything. So you need a PhD in finance or have to monitor the market 24 hours a day, 7 days a week. This is not true. You don't need to look at the market all the times. You just have to buy the shares, or invest the money and then forget for years. Right. Simplicity often beats complexity in the investing world. Now, the power of simple strategies, and we will be discussing Warren Buffett's advice. So, in fact, some of the most successful investment strategies are incredibly simple. The legendary investor Warren Buffett, you know what he did? He has said that for years, the best course of action for most people is to simply buy a low cost S&P 500 index fund. If you're from India, the Nifty, or the Sensex Nifty 50 is basically the top 50 companies of India. Similarly, in S&P 500, it's like top 500 companies of the United States which are listed in the stock market. So that is S&P 500 index fund. So basically, index fund is basically the top companies of a particular company, and they have a index fund. So basically, you are investing in all those top 500 or 50 companies, and you have like basic shares from it. And when it will grow, all the 500 companies would grow. So what will happen? Your wealth will also grow. Now, sometimes what happen, out of these 500 companies, one company might be there, or 10 companies might be there which are not performing good. So if you had particularly invested in up that particular company, so you would be losing money. Whereas if you invest in investing index fund, so what will happen? Even if 10 companies are at loss, 490 companies are still in profit and they are growing. So overall, it will be growth and it will be profit, right? So now let's talk about myth 4. To make real money, you have to time the market. This is also a myth. Knowing the perfect moment to buy and the perfect moment to sell high, the media loves this narrative. The idea that a savvy trader can dance in and out of the market, sidestepping every crash and catching every rally. This is not possible. It will never happen with you. Like, you will always buy at low and sell at the highest point. It's not true. We just have to in a graph, when it grows, we just have to take care that we are buying at somewhere near low, and we have to sell high. Obviously, you cannot be accurately buy and sell trades at whatever. Nobody knows what's the lowest point or what's the highest point. Now, time in the market is more important than timing the market. So 7 out of 10 best days missed. Missing the 10 best days in the market over 20 years can reduce your returns more than 50%. So, and 89% market timers fail, and 74% of the days are positive. So basically, what happens is that nobody can constantly predict what the market will do tomorrow, next week, or next month. Study after study shows the investor who try to time the market almost always do worse than just who stay in the market invested for long years. Missing just a handful of market best days can devastate your returns. So repeat after me: time in the market is more important than timing in the market, right? Now, one more myth: a stock that has gone up a lot must come down. This is something is like that. If a stock has risen, then it will say that it will create a flip and it will again come down. This is not true. If something has gone up, it maybe might be staying up over there. So this is not true. So great companies keep growing for decades, and it's not something like that. If a particular graph is growing like this, so it will come down. It will not happen. Maybe it might be possible that it will grow, and falling stocks can fall further. A declining stocks, for example, a stock was at 100 rupees and it came down to here 50. Now you are thinking it will again go to 100. It's not certain it will go to 100. It might go like to 25 or something. So that will be worse. So it is always not true that falling stocks will recover or do something. People are just betting with their own mind, and they are not consciously evaluating or thinking while their money is stuck. So it's too late for me to start. This is another myth. It's never too late. I told you the best day was yesterday and the second best day is today to start investing. Also, the second best time was to start yesterday and the second best time is today. I told you this, right? So these are all the myths which we have busted, and I hope you don't fall into any traps of media or some people giving you tips. Nobody knows what is going to happen. I'll tell you how you can make money uh, with basically with a small amount, and you just have to wait for some time, and the compounding is really great. So the key takeaways: you have to start small. It's not necessary you need a lot of capital. Also, don't bet. Investing is not gambling, so do proper research, and uh, you're becoming a part owner of a real business that creates value, not just placing random bets. If you place random bets on any stock, it is gambling then. Keep it simple. You don't have to be a financial expert. If you don't want to do research or all, just put your money into index fund. Every stock exchange has its own index fund, so you can put your money over there and then you can relax. Now, stay invested. Don't try to time the market. Time in the market beats timing the market every time. Don't be like the market has fallen, I should more money, and the market is high, I should sell off everything. Don't do this. Don't fall for short profits to they will eat up your large profits. Also, focus on quality. Price direction alone tells you nothing. Focus on business fundamentals, not just recent price movements. Start today. It's never too late, right? So, next up, getting personal with your goals. In the next lecture, we will shift from journal principles to your personal situation. How to set clear, meaningful financial goals that truly matter to you. Understanding your unique tolerance for risk and volatility. Creating an investment strategy that aligns with your personality and life circumstances, matching your investment approach to your timeline objectives. So, I will be telling for everyone, whether you're a businessman, self employed, or you have a job. So, how much time you can invest in here, and how much money should you invest in here, how you could diversify your portfolio. We will be talking about everything. So, basically, investing isn't one size fits all. What works for someone else might not work for you, so that's perfectly fine. And you are making excellent progress. This is lecture 4, and in the next lecture, we will be, setting up goals. So I'll meet you in the next lecture. Thank you. Welcome to the final lecture of our foundational section. So far, we have talked about the big picture. Now, we are going to make it intentionally personal. This lecture is all about you, your goals, your dreams, and your unique personality as an investor. We will learn how to set clear financial goals and how to understand your own tolerance for risk. So, let us begin. You need a why. Investing without a goal is like driving without a destination. You'll simply wander aimlessly, making random turns without progress. Your goals are the compass that determines your entire investment strategy. So, what you invest in, how long you stay invested, and how much risk should you take. So, now we have a formula for this that is introducing SMART goals. Don't just say, I want to be rich. That's too vague to act upon. Be specific and strategic. So you have to be specific, you have to clearly define what you want to achieve. Then measurable. You can track your progress with numbers. And it should be achievable also. Set realistic targets within reach. Don't just put like very target something like that is not achievable. And then it is relevant. It should align with your life priorities. Also, it should be time bound, set a clear deadline for it. So, smart goal. So, for example, a vague goal is something like I want to save for retirement. That sounds nice, but it's an impossible plan for or measure. Now, smart goal here is that specific. I want to have 8 crore investment portfolio when I retire. It should also be measurable that I can track my portfolio's value monthly. It is also achievable if you invest 40,000 per month, and it is also relevant. This will allow me to retire comfortably. It is time bound. I want to achieve this by age 65 in 30 years. So you have all the smart goals: specific, measurable, achievable, relevant, and time bound. So you should also write your smart goals, that what you want specifically, and what is measurable, and what is achievable, and what is relevant, and what is time bound. So now there are some common investment goals. So first there is this short term goal that is from 1 to 3 years, that says buying a car, saving for a vacation, building an emergency fund or something like that. Also there are some midterm, down payment for a house, starting a business, child's wedding, etc., etc., and long term such as retirement, child's education, financial independence, etc. Now, what is risk tolerance? Now, for the second piece of the puzzle, risk. Risk tolerance is your emotional and financial ability to handle ups and downs in your investment portfolio. It's fundamentally how well you can sleep at night when the market is falling or your portfolio values drop. Now, there are two parts to risk tolerance. First is the ability to take risk. This is based on your financial capacity to handle losses. How stable is your income stream? Do you have an emergency fund or not? How long will you need the money? Your time horizon. For example, a 24-year-old boy with steady income has a higher ability to take risk than a 60-year-old retiring man. So now there is willingness to take risk. This is your emotional comfort with uncertainty. What's your personality type? Are you thrill seeker or do you prefer playing it safe? How would you feel if your portfolio dropped 20% in a month? You might have the ability, but not the willingness, or vice versa. The risk spectrum. Where do you fit? Conservative, moderate, or aggressive? So, this generally places investors on a spectrum. On one end, you have the conservative investor who prioritizes protecting the money above all else. In the middle, the moderate investor who looks for a balance, and on the other end is the aggressive investor who is willing to take on more risk for the chance at higher return. I want to be very clear, there is no best category. The only right answer is the one that is true for you. So you could be anyone, but it depends that how much extra money do you have for taking risk, or do you just want to play it safe, something like that. Let's do a quick test. Imagine you invested 10 lakh rupees in a stock market. 1 month later, the market has dropped by 20%, and now your portfolio is worth 8 lakh rupees. Basically, you had a loss of 2 lakh rupees. Now, what will be your first reaction? Panic, sell everything before it goes lower. Or something like, I'm nervous, but I'll hold and wait. Or third could be, The market is on sale, time to buy more. So, for example, uh, when uh, when one panics, so basically he has lower risk tolerance, he cannot handle any kind of loss or risk, so they are conservative, and this is moderate, and this is aggressive. Market is falling, it will recover and give us good return, so buy more, the market is on sale. Now, the golden rule: your goals and your risk tolerance must align. Don't be an aggressive investor if you have a conservative personality. You'll panic and sell at the worst time, and you'll just have losses. And don't be also a conservative investor if you have a long term or aggressive goals. So, basically, if you want more returns, so you'll have to take more risk. So, you could lose money also. So, it depends upon your personality. How do you want to do it? Now, bringing it all together: your financial goals, why, your risk tolerance, and your investment strategy. So, first, be clear uh, with all your goals. How much do you want money? Whether you can take risk or not? Whether are you ready to lose money or not? And it's not like you will, but there is a possibility that you can lose if you are a very aggressive trader. So, this is the section one recap. So, we have studied everything. We know why we should invest, we know what we can invest in, and we have busted all the myths, and we have made it personal. So, this is the section one recap. Now, this was the foundational section for this course. In the section 2, we are going to dive deeper into how the stock market actually work behind the scenes. Now, what's coming up: the mechanics of stock exchanges, understanding market indices like Nifty 50 and Sensex, how buying and selling actually happens, reading the stock market movement and trends. So let's keep the momentum going. You are on your way to becoming a confident investor. So I hope you have built some foundation, and in section 2 we are going to start building on top of it by diving into the nuts and bolts of stock market. So I'll see you in the next section. Thank you. Welcome to section 2. We have built our foundation, and now we are ready to start building the house. In the first lecture, we are going to go deeper on a topic we have already touched on. What is a stock really? We'll go beyond the simple definition and understand what it truly means to be an owner. Now, let's take a quick recap what we have learned so far. So, in the previous section, we discovered that stock represents ownership in a company. But what does that actually mean in practice? Let's break down this concept with a simple, relatable analogy that brings the abstract of the world of stocks into everyday life. So, for example, the pizza shop analogy. You own a thriving pizza shop. Your pizza shop is incredibly popular with queues out the door every evening. Business is booming. Now it's time to expand. You want to open a second location across a town to serve more customers and grow your brand. Now there's a money challenge. Need 82 lakh rupees more, approximately, let's say $1,000, well, $100,000 for the new shop, but you only have 41 lakh available. So the solution is to sell ownership. Instead of taking a bank loan, you decide to sell a portion of your business to raise the remaining capital. Now, selling shares of your pizza business. So basically, what will happen? Divide into shares. You divide your entire pizza business into 10,000 equal slices, each called a share. Now you can set the price. You decide to sell 5,000 shares at 820 rupees per share to the public. Now, here how you can raise the capital. So 5,000 into 820 is basically 41 lakh rupees. So exactly what you need. So this is the real ownership example. If your friend purchases 100 share, now they own 1% of your entire pizza business. They are legitimate co-owner entitled to 1% of the profits and say in major decisions. Now, why do companies sell stocks? The pizza shop scenario mirrors exactly what real company do in the stock markets. They sell stock to raise capital, money needed to fuel growth and innovation. So business expansion, for research and development, to pay off debt if any at company, or acquire other companies. So purchasing competitors or complementary businesses to strengthen market position and capabilities. Now there are two type of companies, that is private and public. So not all companies sell their shares to everyone. You need to understand the difference between private and public companies, that which is crucial for investors. So private company is owned by a small select group, typically founders, family members, or early investors. Shares are not available on public stock exchanges for general purchases. Greater control and privacy, but limited access to the capital. Example: our pizza shop before we sold shares publicly. Whereas a public company has undergone initial public offering (IPO) and sold shares to the general public. Anyone can buy their stock through stock exchanges like NSE or BSE, subject to strict regularity, oversight, and public disclosure requirements. Now you can see the example of Reliance Industries, Tata Consultancy Service, Infosys, Apple, McDonald's, anything. They are all public companies. What do you get as a shareholder? So, when you buy a share of a public company, what do you actually get for money? Two main things. First, a claim on company earnings. If the business is profitable, you are entitled to your share of that profit, which is often paid you out as a cash dividend. Second, you get voting rights. You get a say in the company how is by voting its board of directors. For most common stock, one share equals to one vote. So more share means more influence. Now there's importance that some company issue different classes of stock. For instance, class A shares might have voting rights while class B shares may not. Now the ticker symbol, your company's stock market nickname. Every publicly traded company has a unique identifier ticker symbol, a shorthand code used on stock exchanges worldwide. Think of it officially stock market username. They are symbols between typically 1 to 5 letters and make trading quick and efficient. For example, TCS for Tata Consultancy Service, Reliance, Apple, Tesla, we have TSLA for Tesla. For Google, we have GOOGL. The parent company is Alphabet. So these ticker symbols appear everywhere: news, tickers, trading platform, financial websites, and investment apps. They are the universal language of stock trading. Now, let us talk about the key takeaways from this lecture. Let's wrap up. So, the real ownership, a stock represents a genuine piece of ownership in an actual business, not just a trading instrument. Capital raising, companies sell stock to raise capital for expansion, innovation, debt reduction, and acquisitions. Also, some shareholder rights. As a shareholder, you have to claim on company profits, dividends, and voting right in major decisions. Also, there are ticker symbols, codes between usually 1 to 5 letters, identify each on exchanges, making trading standardized and efficient. So, next up, where does stock trading happen? The marketplace awaits. We will be discussing this in next lecture, and I'll see you over there. Thank you. Welcome back. In our last lecture, we learned that the company sells stocks to raise money. But where does this transaction actually happen? The answer is that there are two distinct markets, and today we are going to make the difference crystal clear about the primary versus secondary market and the journey of initial public offering, that is IPO. Now, there are two different arenas. When we discuss the stock market, we are actually referring to two separate but interconnected marketplaces that work in tandem to create a complete investment ecosystem. The primary market, where stocks are born, companies issue brand new shares directly to investors for the first time. The secondary market, where stock change hands, investor trade existing shares amongst themselves daily. Now let us talk about the primary market. This is where the actual stocks are created and sold for the very first time, the birthplace of every share that exists in the market today. Think of it as the new issue market where companies come to raise fresh capital for growth, expansion, or business operation. The crucial difference is that the money from the sale flows directly to the company issuing the stock, providing them with valuable resources to fuel their ambitions. Now, the car analogy, the primary market. For example, the primary market operates like a car manufacturer. Imagine Ford selling a gleaming brand new 2025 Mustang straight from the factory floor to its very first owner. So, Ford factory manufactures the new Mustang. The first buyer purchases directly from the Ford. Now, Ford receives money, the capital goes to the company. So, this is the primary market, the first uh, owner of that particular share. The money from that sale goes directly to Ford, not to any previous owner, because there wasn't one. This is how the primary stock market works. So, the IPO, the initial public offering. So, the biggest and the most exciting event that happens in the primary market is an IPO, which stands for initial public offering. This is the moment a private company like our pizza shop from the last lecture sells its shares to the public for the very first time. It's their grand opening, their debut on the world stage, and it's how they raise huge amount of capital for fund for future growth. So it has a private company status, then they decide to go public, then there's an IPO launch, and public company birth is done. Now comes the secondary market. This is where the stock market you hear about on the evening news every single day, the heartbeat of daily trading activity. Now, how it works, investors buy and sell stocks from each other, not from companies. The companies whose stock is being traded is not directly involved in these transactions. Money flows from one investor's account to another's, a pure exchange between market participants. Now, the key characteristic, unlike the primary market, the company receives no money from these trades. The capital simply circulates amongst investors who are buying and selling positions. Now, the car analogy for the secondary market. The secondary market functions exactly like the used car market, a marketplace for pre-owned assets. That person who purchased the brand new Mustang now wants to sell it. They find another driver who is interested and complete the sale. Now, critical question: did Ford receive any money from that transaction? No, absolutely not. The money went directly to the new buyer from the previous owner, and whatever the difference is, it might be a profit or it might be a loss, that will be received by the previous owner. Now, the flow of money, primary market, investors' money, the company. Fresh capital is raised to fund operations, expansion, research, or pay off debts. The company receives real money it can deploy. There is also secondary market, investor A's money, investor B, and investor A share to investor B. A simple exchange between market participants. The company is merely a spectator to this transaction, and the company has nothing to do with these profits or losses. Why is the secondary market so important? If the secondary market doesn't actually fund companies, what is its purpose? Why do we need it? We need it for liquidity. Liquidity is the ability to easily and quickly buy or sell an asset in case your stock shares and convert it into cash, significantly affecting its price. So you can do it without the secondary market and with the secondary market. Uh, so without the secondary market, you will be stuck, and it will be nearly impossible to sell share because no marketplace would exist you finding buyer. You might get a buyer, but like that's going to be very difficult and rare. Within the secondary market, the flexibility makes people willing to invest in the first place, and you could sell your share within seconds. So the secondary market's existence may actually makes the primary market possible. People buy IPO shares because they know they can sell later if needed. Now let's visualize the journey. We have already understood, first there is a private company, for example any Pizza Shop Inc. Then it uh, goes to the primary market for the IPO. Then secondary market trading is done and company is just an observant over here. So the key takeaways from this is that primary market definition, where new stocks, brand new stocks are issued and created through IPO. Secondary market definition is that where existing stocks trade between investors on exchanges. Money flows from one investor to another. The company is not involved in these transactions. Now there is a critical role of liquidity. The secondary market provides essential liquidity, allowing investors to convert shares to cash quickly. This liquidity is what people willing to invest in stocks initially. Now, where you will trade as a regular retail investor, you will always be trading in the secondary market, buying shares from and selling to other investors through exchanges. Next up, we will be talking about the stock exchanges and market indices. Now, in the coming lectures, we have NYCE, NASDAQ several times throughout the presentation. But what are they? How do they function? We will be learning all that. Also covering, we will study about the market indices like Sensex, Nifty 50, S&P 500, and the Dow Jones Industrial Average. You'll learn how we measure the market performance and why these numbers matter to every single investor. So I'll see you in the next session as we continue building your stock market knowledge. Thank you. Welcome back. We now know that we do our trading in the secondary market. But where is the secondary market? What is it? In this lecture, we will visit the actual marketplaces, the stock exchanges, and then we'll learn how to take the market's temperature using indexes. Now, let us first talk about what is a stock exchange. So, a stock exchange is simply a marketplace where stocks are bought and sold. It serves as the central location, whether physical or virtual, where buyers and sellers meet to conduct transactions. Stock exchanges ensure that trading is fair, orderly, and efficient, operating under strict regulatory oversight. Think of it like a highly regulated farmers market, but instead of fresh produce, participants are trading ownership stakes in companies. These exchanges provide transparency, liquidity, and a framework that protects investors while facilitating capital formation for a business. So the two big in US is the New York Stock Exchange. The iconic NYSE represents traditional Wall Street, combining human expertise with modern technology. And there is Nasdaq, the fully electronic exchange known for its technology focus and innovative trading systems. So while these are numerous exchanges worldwide, two stand out as the most influential: New York Stock Exchange and Nasdaq. Both are headquartered in the New York City and together represents the epicenter of global financial markets. Now, talking about the NYSE, New York Stock Exchange, it was founded in 1792, over 230 years of market history, making it the world's oldest continuously operating exchange. It also has the physical trading floor, still maintains the iconic trading floor where human brokers facilitate trade along with electronic systems. Now, the blue chip have been home to established giants like Coca-Cola, Walmart, and Johnson and Johnson. So this is how they work. Also, the Nasdaq, the world's first electronic stock market, revolutionized trading by eliminating the need of a physical trading floor entirely. All transactions occur through sophisticated computer networks, enabling faster execution and greater efficiency. It may Apple, Microsoft, Amazon, Tesla, everything is present over there. Now, what is the stock market index? We need to understand that. So, here's a quick definition. A market index aggregates multiple stocks prices into a single figure, making complex market movements easy to understand at a glance. For example, there are top 50 companies over here. This is going up by 5%, this is going down by 10%, and this is going up by, let's say, 15%, this is going down by 25%, this goes up by 50%, something like this. So how do I study all this and how do I know where the market is going or not? So basically I have this combined index for all, and this can tell me this is going plus 2% net up. So this is how I can get the stock market index, and I know that the market is moving upwards. So this is where an index becomes invaluable. An index is sophisticated tool designed to track performance of carefully selected group of stocks. So all these companies which I talked about, so these are going to be a particular group. For example, in Nifty 50, it is going to be the top 50 companies of India, right? And then we'll get a index fund from here. Rather than monitoring thousands of individual stocks, indices offer a simplified yet accurate representation of market movements. The thermometer analogy. The best analogy for an index is thermometer. When you look at the thermometer on the wall, it tells you the temperature in the room. It isn't measuring every single molecule of air. It is taking a small representative sample. And index does the same thing. It takes a sample of stocks to tells the temperature of the overall market. The three famous indices, uh, which is the S&P 500, the gold standard for measuring US market performance. It contains all the top 500 companies. The Dow Jones Industrial Average, the oldest and the most historically significant index, and the Nasdaq Composite, the definitive measure of technology sector health. Each index serves as a distinct purpose and offers unique insights into different segments into the market. So the S&P 500 companies representing all major sectors, 80% of the market coverage of US market capitalization. So it is Standard and Poor's 500 index tracks the performance of 500 largest and most influential US companies in broad composition spanning technology, healthcare, finance, consumer goods, energy and more, makes it exceptionally diversified. This is the benchmark that most investment professionals use to measure the health of the US stock market. When someone asks how's the US stock market doing, they typically refer to the S&P 500. We have also Dow Jones Industrial Average that was created in 1896. Charles Dow established the index to track industrial companies. Now it is a historical icon, and today it has 30 companies, top major firms like Boeing, McDonald's, Disney, and Goldman Sachs. Now the Nasdaq Composite, all companies listed on Nasdaq, and it has a technology focus, heavy weighting towards tech sector. The comprehensive index tracks all of the stocks that trade on the Nasdaq exchange, over 3,000 companies in total. So this is how it works. Now the key takeaways from this lecture is that the NYSE and Nasdaq are the primary marketplaces where stocks are bought and sold, each with distinct characteristics and listed companies. Also, market indices, the S&P 500, Dow Jones, Nasdaq Composite serve as thermometers that measure the overall market performance through representative samples. Also, the gold standard, the S&P 500 stands as the most important and widely used benchmark for gauging the health of overall US stock market. In India, we have NSE as a stock exchange, that is National Stock Exchange, and BSE, which is Bombay Stock Exchange. So every country has its own index fund, and for different group of stocks or sectors, we have different indexes. So next up, we are going to talk about the bulls, bears, and the market cycles. What are bull markets, bear markets, and the market psychology? So we will be discussing in the next lecture, and I'll see you over there. Thank you. Welcome back. If you have ever listened to financial news, you have probably heard of people use strange terms like the bulls are in control. We are heading into a bear market. Today, we are going to translate that language. We'll meet the famous animals of the Wall Street and understand the natural cycles of the market. So, the market has a mood. A stock market doesn't move in a straight line, it breathes, ebbs, and flows with a collection of emotions of millions of investors worldwide. Sometimes it surges with optimism and growth, other times it retreats with fear and decline. To make sense of these patterns, investors have borrowed two powerful symbols from nature, the bull and the bear. So, the bull market, rising prices and optimum reach and strong economy. Businesses are thriving, unemployment is low, and consumer is spending too robust. Why a bull? A picture of bull in an arena. When it attacks, it thrusts its powerful horns upwards into the air. So market going up, says bulls. The upward motion perfectly captures the rising trajectory of the bull market. Talking about the bear market, the swipe downwards. A bear attacks by swiping its massive paws downwards. mirroring how markets decline during bearish period. Official definition: a bear market is declared when the prices fall 20% or more from the recent peak levels, sustained over at least 2 months. The mood shifts, widespread pessimism takes hold, investors worry about their portfolios, news headlines turn grim, economic indicators signal trouble ahead. So there is economic slowdown. The broader economy often slows at down or enters recession with companies cutting back and unemployment rising. So it's a cycle, not a straight line. The stock market is not going to be something like this. It is always going to be like this. So market moves in predictable cycles alternating between bull and bear phases. This cyclical nature is not flaw, it's a fundamental feature of how the market works. So good news for investors is that historically bull markets last much longer than the bear markets. The long term trend is always upwards. So people always make money usually. So this is how it works. Now the four phases of a market cycle. We can break this cycle into four phases. First is the expansion phase. That's the long healthy bull market where stocks are rising. Eventually uh, that reaches a peak where optimism is at the highest. From there we enter a contraction phase, the bear market. Economic growth slows, corporate profits decline, and stock prices fall. And that is eventually hits a trough. The maximum pessimism right before the cycle, you know, uh, goes again upwards. So here it's expansion, like expansion is like this, then it hits the peak, then contraction, and then trough, the lowest point, then it again goes up. So this is how these are the four phases of the market in this, how it works. Now there are other important terms to know, that is market correction. A short term market drop of 10 to 20% from recent high. Think of it as the market pressing the reset button, more common than full bear markets. Often healthy for long term market stability, allows overheated valuations to cool down. For example, if it has risen because of a lot of optimism, so market will correct itself and market correction will happen. This will be around 10 to 20%. Right. Now there is also going to for a market rally, a sustained period of rising prices creating upward momentum in the market. They can even occur in the bear markets, called a bear market rally, often signals the start of a new bull market driven by renewed investors' confidence. So, when it creates upward movement, we call it rally. Now, how should a long term investor think? Don't fear the bear. Reframe your perspective. A bear in the market isn't a disaster, it saves. Quality companies you have been watching are suddenly available at a discounted price. You need to shift your mindset. Move from panic, I am losing money, to opportunity, everything is on sale. Your emotional response determines your financial outcomes. Remember the golden rule: it's not a loss until you sell. Paper losses are temporary. If you believe in investments, hold steady or even buy more. Don't panic and sell. So, the key takeaways from this lecture is about the bull market. Prices thrust upwards like a bull's horn. Optimism, confidence, and growth defines this phase. Also, there are bear markets. Prices swipe downwards. 20% declines like a bear's paw. Pessimism and caution dominate. Now, the historical truth is that the market has always recovered from the downturns and gone on to reach new heights. These I'm talking about index funds, not about a particular company. A particular company might get crashed, or it might, even close. Talking about the indexes and obviously the blue chip companies. Your advantage: understanding cycles give you the emotional resilience to make smart decisions when others panic. Now, next up, we have the complete ecosystem. We will be talking about the brokers, the regulators, and more the full cast of market participants. So that is will be the final lecture. the next lecture of section 2, and we will be covering all the basically how what is a stock and how it is being traded, what is bull market, bear market. We've all you know covered in this section, and in the next section we will be um, talking about all these brokers, regulators, your gateway to the markets, the regulators, the referees ensuring fair play, and more. So I'll see you over there. Thank you. Welcome to the final lecture of section 2. We have covered a lot of ground, from what a stock is to the cycles of the market. Now we are going to zoom out and look at the entire ecosystem. We will meet all the key players who have a role in making the market function every single day. So it takes a village. The stock market isn't a computer program or an abstract concept. It's dynamic, complex ecosystems of different groups, each fulfilling a specific and vital role. Understanding who these players are and how they interact is essential to grasping how the market truly functions. Let's meet the main players who keep this financial engine running smoothly. So, the player one, companies, issuers. This is the starting point where they issue the shares. This is where the entire stock market journey begins. Companies are the businesses that issue stock to raise capital for expansion, innovation, and growth. Whether it is a tech giant like Apple or automotive leader like a Ford or even your local pizza shop going public, these are the entities offering ownership stakes to investors. What drives value? The success, profitability, and future potential of these companies are what give their stock market its fundamental value in the marketplace. When a company thrives, shareholders benefit. When it struggles, stock prices reflect that reality. It's a direct connection that makes stock ownership so powerful. Now, let us talk about the player number two, investors, us. This is the only group that buys the stocks that company issues. The investing world is divided into two main categories, each which with distinct characterizations and market impacts. Retail investors and institutional investors. So, retail investors, that's us. Every day, that's you and me. Everyday people investing our own savings. Then there are institutional investment investors, the big money players. These are large organizations like mutual funds, pension funds, hedge funds, and insurance companies that invest on behalf of others. They command enormous capitals and make the majority of the trades, often moving the markets with their decisions. Now, there are also player number three that are brokers, the gatekeepers. Here's a critical question: how do we, as retail investors, actually buy a stock on the NYSE or NASDAQ? We can't just walk into the exchange and place an order ourselves. We need a broker, a licensed intermediary company that is authorized to buy and sell stocks on your behalf. Think of them as gatekeepers who connect individual investors to the stock exchanges. Brokers handle the technical aspects, executing trades, maintaining account, and ensuring compliance with regulations. They are essential bridge between your investment decisions and the actual marketplace. So there are popular brokers, for each stock exchange wherever you would like to place your orders. Now, the player number four, that is stock exchanges, the marketplace. We've learned about this already: the NYSE, NASDAQ, NSC, or BSC. These are all stock exchanges. Their job is to bring all the buyers and sellers together in one place to conduct business in a fair, orderly, and efficient fashion. They provide the infrastructure, rules, and technology that make trading possible, ensuring transparency and equal access for all participants. Now, player number five, the regulators, the referees, protect investors and to maintain fair markets and enforce transparency. So in US there is SEC, that is Securities and Exchange Commissions. In India we have SEBI. Their role, they act as referees. So to ensure that the game is played entirely fairly and nobody is cheating, you need a referee. In the United States, we have the SEC. Think of them as the stock market police. Their job is to protect investors like us, to ensure companies are reporting their finances honestly and to maintain fair and orderly markets for everyone. Now, how it all fits together. Companies issue stocks, investors wants to buy, you order through broker, then exchange matches order, and SEC oversees everything. So they are just watching. Um, this is how it works. So let's trace this one more time. A company issues stocks. We as investors, we want to buy. We log into our account with our broker and we place our buy order. The broker zaps that order into the stock exchange. The exchange finds a seller and for us to execute the trade. And the whole time, SEC is monitoring us and making sure all rules are being followed or not. Now, this is the recap of section 2. Brilliant work. You have learned how the stock market engine runs and who operates it. Let's recap the key concepts you have mastered. You know, stock represents real ownership. There are two markets, primary and secondary. Primary markets through IPOs, and then in the secondary market, that shares are traded. We have also have exchanges versus indices. For example, we have New York Stock Exchange, Nasdaq, that are the actual marketplace, and we have also the indices like S&P 500 are the measuring tools that track market performance. There are also bull and bear cycles. The market moves in cycles, bullish periods of optimism and rising prices, and bearish periods of pessimism and falling prices. There's the complete ecosystem. You now understand the five key players: companies, investors, brokers, exchange, and regulators, and how they interact. So, this was all in the section 2. Congratulations. Now you have entirely, completed all the foundational theory of stock market, how everything works. You know more than 90% of the population about how this powerful wealth creation works, from basic mechanics to sophisticated ecosystem of players. So you understand what stocks truly represent, how market functions, who the key participants are, and how they all work together. So, next up in section 3, it's time to practice. Enough of theory. It's time to get our hands dirty and move from knowledge to action. In the next section, your investing toolkit, we are going to get completely practical and hands on. We will be choosing the right broker for your needs, opening your very first brokerage account, and understanding how to place an actual trade. Let's go. And I will see you in the next lecture. Thank you. Welcome to section 3. The theory is done and now the real fun begins. In this section, we are going to build your practical toolkit. And the very first tool you need is a brokerage account. In this lecture, we will cover how you to choose right broker for you. So what is a broker? A quick refresher. Just to recap from our last section, a broker is your essential partner in this process. They are the licensed company that connects you, a retail investor, to the big stock exchanges. You can't buy stocks without one. So picking up a good one is really essential. So there are two main types of brokers: the full service brokers and discount brokers. So full service brokers offers a wide range of services including personalized financial advice, wealth management, and comprehensive retirement planning. Much higher cost with commissions, advisory fees, and management charges. For example, you have Edward Jones, Merrill Lynch, etc. Now there are discount brokers. They focus on providing streamlined platform for you to make your own trades with minimal handholding. It costs much lower, often commission free for stock trades and putting more money in your pocket. So I would recommend you to go for this. This is what most individuals investors use, and that we will focus on this course. For example, Fidelity, Charles Schwab, and in India we have like Zerodha or Grow. In India we have these. For every country there are like different brokers, so you can search. Now, the key factor one, you have to focus on the fees and commission, how much they charge you, because every time you will be executing a trade, so they will charge you every time you buy a stock, sell a stock. So, most major discount brokers now offer zero commissions for online stock and ETF trade. This is a massive win for individual investors, saving thousands over time. There are other fees to watch for annual fees, for account maintenance, inactivity fees, fees regarding certain rates for mutual funds, and wire transfer and withdrawal fees. So you have to check for all these. So basically, how do they, if they are charging zero commission, how do they make money? So they make money when you trade in FNO, that is futures and option trading. We will be seeing what is this too. Now the key factor two, investment options. So the stocks, ETFs, mutual funds, bonds. So good for beginners. Almost any major discount broker will provide you all the investment options you need to build a solid portfolio. Now we have tools and research. Basic platforms, they are simple, clean, intuitive interfaces designed for straightforward investing. Perfect for beginners who want to buy, hold, and monitor their investments without complexity. There are also advanced platforms, sophisticated charting tools, customizable stock scanners, real time data, and in depth research reports. Great for active traders, but potentially overwhelming for newcomers. So remember, more features aren't always better. Don't let yourself overwhelmed by the tools you won't actually use. Now, the key factor four, ease of use and support. User interface. Is the website and mobile app intuitive and easy to navigate? Can you find account information, make trades like easily? How is the UI UX? Mobile experience, does that same work in mobile and like with full speed, and the UI UX is great. Also, how is the customer support? How accessible is their support team? Can you easily reach a knowledgeable human if you encounter a problem? What are their support hours? And you can also research and reviews, and you could talk to your family and friends which broker is good for you. So which one is the best? There's no single best broker for everyone. The ideal choices depends on your personal needs, investing style, and preferences. For example, some might like some kind of UI UX user interface, but some people won't like that kind of user interface. So it's up to you. You can choose any of this, and it's very easy to place a trade on that. Now, my recommendation is that don't overthink. Just go for any of the one broker that is good, reliable, and charges you less. So you can just go with it. But stick with the established players. Choose the one that is well established and well known. They've earned their standing through years. Now, get started. The most important thing is to take action. The best broker is the one you'll actually use to begin with your journey. So, this is how you have done. Now, you have to open your account. We will be seeing that in next lecture. Thank you. Welcome back. You have picked out your broker, and now it's time to get the keys and open the door. In this lecture, I'm going to walk you through the simple process of opening your first trading account. My goal is to just show you how easy and non-intimidating this really is, right? So don't be intimidated. Opening a brokerage account is remarkably similar to opening a standard online bank account. It's a secure, regulated, and straightforward process that makes millions of Indians have completed successfully. The best part, you can usually complete the entire application in about 15 minutes from the comfort of your home. So there's no need to visit a physical branch or deal with the complicated paperwork. Now, information you need, that is identity proof, PAN card, that is mandatory for all investment accounts in India, and Aadhaar card for verification. You'll also need some contact details, some bank information, and some financial information like about your approximate annual income or something. Having these ready will help you complete the application quickly. Now, you could also choose your account type, that is individual demat and trading account. This is a standard trading account. For most of us, the choice is simple, individual brokerage account. This is just a standard taxable investment account that is owned by one person. You may see also a joint demat trading account option also, which is generally for if you are opening an account with a spouse, for example, or someone else in the family. So great for families managing investment together, but requires coordination between all account holders. Now let us talk about understanding account options. So When opening your account, you might see various options of add-ons. Don't worry if some terms are unfamiliar. You might see commodity trading, currency trading, or future and options. So commodity trading is used for investing in gold, silver, or agricultural products. Currency trading is for trading in foreign exchange markets, and futures and options is advanced derivative instrument. As a beginner, you can safely skip these advanced features, focus on opening a basic equity trading account to buy and sell stocks and mutual funds. We will be studying all these three in our course also. So don't worry, I'll explain you everything. So you can always add these features later once you gain experience. First, you need to start simple and expand your capabilities as you learn more about investing. So the application process is very simple. You visit your broker's website, then you select your account type, fill in the personal information, complete the verification, sign the agreement digitally, and submit it and wait for approval. You will just do it. It's very simple. Now, you can fund your account. So you could also fund recurring deposits, that is SIP, and you could also just transfer for one time and whatever you want to buy or do with that money in that account, you can do it. Now, understanding margin, keep it simple. Cash account delivery trading. So there might be like two things. There might be margin facility. So I'll explain you this now. So cash account delivery trading. You can only invest the money you have deposited. If you have 10,000 in your account, you can buy stocks worth 10,000. Simple, safe, and transparent. This is what you should do as a beginner. But there are some margin accounts also which leverage trading. It allows you to borrow money from the broker to invest more than you have. This is an advanced strategy, amplifies both gains and losses. So it will amplify your gains as well as your losses. So it involves a significant risk and interest charges. So for example, what will happen here? What will happen if you have 10,000 rupees? You can only use 10,000 in a cash account. Whereas in a margin account, if you have 10,000 and you can use 30,000 rupees, 20,000 you can borrow from the broker, right? But now what will happen if in on 10k, if you were supposed to make 1k profit, 1,000 as profit, in 30,000 you will make 3,000 as profit. But you need to remember there will not always be not profit. There might be loss too. So this 3,000 might also you end up losing also, but you will lose from this 10,000. So if you lose 3,000 from 10,000, you will be only left with 7,000. That's 30% down on one trade. So leveraging is good and is it is also bad. So it amplifies both your potential gains and losses. So as a beginner, you should just focus on the delivery trading. Congratulations, you have now opened an account. Don't rush. There's no pressure that you have to buy it today or something like that. Um, Now you are the proud owner of a funded brokerage account. You have officially made the leap from a saver to an investor. Before you do anything else, I encourage you to just log in and spend a few minutes clicking around, get the feel for it, for the dashboard. It might look at overwhelming at first, but you'll get the hang of it quickly. So next up will be a guided platform tour. What all you can do on that platform, I'll be discussing with you over there. Thank you. Welcome back. You have your funded account ready. And when you log in for the first time, it can feel that like you are stepping into the cockpit of an airplane, buttons and numbers everywhere. My goal in this lecture is to be your co pilot and give you a guided tour of your new mission control. So, welcome to your dashboard. When you first log in, you will see something that is called dashboard or home screen. It might look a little busy at first glance, but it's thoughtfully organized into a few key areas that work together seamlessly. Our main goal is to understand the main sections so you can navigate with confidence and ease. So every single broker's website look a little different, just like every car's dashboard is laid out differently. But they all have the same core functions: a speedometer, a fuel gauge, and so on. We're going to learn the core functions of the brokerage platform. So the portfolio view. So you can always see total account value, your holdings. Holdings is basically a comprehensive list of all the specific stocks and funds you own with quantities and values. Daily gain and loss, how much are you making money or how much are you losing money in a particular day, and you'll also get to see the total gain and loss, right? So these are the things you would see. Now, here you can track your progress and everything. Now, section 2 comes the watch list. That is your personal stock tracker. See, there are a lot of stocks, but there will be some custom stocks only which you will keep an eye on. So, this is an incredibly useful and simple tool. It is basically a favorites list for your stocks. If you're interested in a company and want to follow this progress before you decide to invest, you can just add its ticker symbol to your watch list. This allows you to easily track a custom group of companies you are researching. So, this is a brilliant tool. Also, then you have some research tools. You can look for a stock and you could view the stock quote page and you could explore key information. Key information such as what is its current price, the price history charts, all the graphs which you see, right? News articles, vital financial data, etc. etc. So, these are all the research tools. For example, you open any of the stock, for example, Apple. So, you'll get the quote page over there. You'll find the current price, historical charts, recent news, etc. etc. Now the order entry screen, this is going to be your action screen. So this is the section where magic happens. The order entry screen, sometimes just called the trade ticket, is the form you fill out to actually buy or sell a stock. Now I have know this screen can look a little intimidating with its boxes and drop down menus, but it's actually very simple. We are going to spend our entire next lecture breaking down line by line so you feel completely confident using it. Right now, let's talk about account services and documents. This is also a section. Here you could get your transaction history, statement, and tax documents, and fund transfer tools. Right. So you could get all these. Now you would also get the layout. The layout is simple. You have the portfolio. What do I own? Track your investments and see how they are performing. Now, the watch list. What am I watching? Monitor stocks you are interested in but haven't purchased yet. You could also do the research. Let me learn about a stock, dive deep into a company data, and make informed decisions. Order entry. I am ready to buy or sell. Take action. You have done your research and you are confident. Then comes our account services, my statements and records. Access all your important documents and account tools over here. So now your homework is that you need to find your portfolio, create a watch list in whichever country you are. For example, if you're in India, you could put the Reliance, TCS, and all the major stocks. If you are watching from US, so you could add like Apple, Starbucks, Nike, such a stock. So look up for a stock, use the search bar to find one of those stocks and discover its current price. So do this, and next up, you can place your first trade. It's not necessary you place it, but I'm just going to teach you how you can place a trade, right? So I'll just tell you how you can place a trade. So three steps have been completed. You have mastered the basics of the dashboard, and how to place a trade I'll be teaching you in the next lecture. So I'll see you over there. Thank you. Welcome back. This is the moment you have been working towards. You have done the research, you have opened your account, you have funded it. Now it's time to take the final step, how to take a trade. So let us understand the order ticket. When you click on the trade button, basically you will get two buttons, buy or sell, over there. If you choose any of those, so basically you will just buy for now. You can't sell it. That is shorting. I'll tell you later in the section that is in advanced topic. So I'll tell you over there. For now, if you want to buy a particular stock, so you'll see a stock every, so maybe there is some a stock which is listed at, let's say, $5. Now here you will see buy or sell. So if you click buy over here, right? So how to place it and how does the order ticket look like? So the four key input every trade requires is that ticker symbol, For example, for Starbucks Corporation, you have this SBUX, or for TCS, you have TCS, Tata Consultancy Services. Now you have to put quantity. How many shares do you want to trade in this transaction? Start small as you learn. So 1, 2, 10, or 100,000, whatever the quantity may be, you have to enter the quantity. Then you have to specify the action, whether you want to buy or sell. So whether you want to acquire shares or sell, dispose of your own shares. Now the order type. How do you want to execute this trade? This is the most crucial decision that determines your control over pricing, right? Now order types controlling the how. So there are two types, which is market order and there is limit order. So it executes immediately at the current market price. For example, there is any stock, let's say A, and it is being traded at 5.25. So if you put market, so it will buy at 5.25. Whereas if in limit order, basically you enter a price over here. For example, you enter $5. So when the stock will come to 5, then only it will buy. If it doesn't come to 5, it will not buy it. For example, from 5.25 it goes up to, let's say, 6. So it will not buy. Whereas if it came down from 5.5 to 5, here it will buy, and then wherever your stock goes. So these are the two types of orders which are there. So this is the market order. It places right now, get me this stock ASAP at the best available price right now. The advantage is that your trade is virtually guaranteed to execute immediately during the market hours. Speed and certainty of execution are prioritized. The drawback is that you surrender all control over the execution price. So you might buy a little higher or a little lower. So the price could fluctuate in split second, click and bit buy and the order being filled. So sometimes you buy at a little higher price. When the market why market orders can be risky, because for example, you see a stock displays at 100 rupees on your screen. You place a market order to buy it immediately. Price moves instantly to 100.5 due to market activity. Now you pay more, right? So your order fills at 100.5. So you have paid 0.5% more. So for large stable blue chip stocks, the price difference is usually minimal. However, for volatile or thinly traded stocks, the execution price could differ significantly from what you anticipated. So for large cap companies and blue chip companies, it might not hurt you, but for any small cap company, it might hurt you. Now talking about the limit order, it says that get me this stock at this price or better. So limit price represent maximum price you are willing to pay or the minimum price you are willing to accept when selling. So the advantage is that you have 100% price control. You will never pay more than your specified limit while buying. This protects you from unexpected price spikes. The drawback is that the order might not execute. Uh, right. So it could be there. Now limit order in action. Practical example. For example, a stock trades at 100. You want to buy it, but refuses to pay more than 100. Now you set a limit order to buy within the limit of 100 rupees. So scenario A could be that the price dips to 99.95. Your order executes immediately at 99.95. Since 99.95 is better than your 100 limit, you get a bargain. And scenario B could be it goes to 100.05 and no execution is there because of the delay. And let's say throughout it doesn't touches 100 again. So your order does not execute. You are protected from overpaying, but you missed the opportunity. So market versus limit, making the right choice. Market order, you could use this when speed and certainty of execution are your top priorities and you are comfortable with a small variation. Best for highly liquid stocks during normal market hours when price stability is expected. Limit order you can use when price control is your top priority and you want to maintain complete command over your execution price. It is best for all situations, especially for beginners, protects you from unpleasant surprises, right? So always use a limit order while starting out. Now there is bonus order type, the protective stop loss. Now let us understand what is a stop loss order. So a stop loss order is a defensive trading tool designed to automatically sell a stock. If its price falls to a predetermined level, think of it as a safety net. It is specially engineered to limit your potential losses if a trade moves against your expectations, providing peace of mind and risk management. Now, the practical example is such that you purchase a stock at 50 rupees per share. To protect yourself, you place a stop order at 45. If the stock price drops to 45, it automatically triggers a market sell order, limiting your loss to only 5 rupees per share. So, what will happen if from 50 it goes to 45? You will sell it, you will take a loss of 5 rupees. It's better to take a loss of 5 rupees. What if it has started to go, it will go till 30? So, it's better you only take a small loss. So this is a stop loss order. So this is your safety net. You might have thought this 50 rupees will go to 60, or let's say 55, whatever. But instead of this 50 to 60, this is going down to, let's say, 30. But over here at 45, I have put a stop loss order. So at 45, it will automatically sell and I'll take a loss of 5 rupees. It's okay. Sometimes taking a small loss is okay when we are predicting to earn 10 rupees. So the risk reward ratios should be correct. Now, you could practice anything. I'm not suggesting you to buy any of the Starbucks or any stock. I'm just telling you, you find a ticker symbol, then you put action, and then you put quantity over there. You can put the order type. It could be market or it could be limit. And you could generally fill it with limit, and the limit price must be something, and you execute the trade. You could also review and confirm the final checkpoint. Before submitting any trade, your brokerage platform will display a comprehensive confirmation screen. This is your crucial final checkpoint. Verify the action. Did you mean to buy instead of sell? This is a common mistake and can be costly. Double check the action. Confirm the number of quantity. Accidentally adding an extra zero can drastically change your investment amount. Check the ticker. Are you buying the right company? Similar ticker symbols exist, so verify carefully. Also, review the price. Is your limit price sensible? Does the total value align with your investment plan? Then you could submit or place order and with confidence, and you could trade. Now, next up, we will be understanding all the trading costs. So, we have covered the exciting part successfully, how you can buy a stock, but there are any hidden costs lurking beneath the surface. So, in our final lecture of this section, we'll pull back the curtain on brokerage fees, commissions, and other charges so you know what you're exactly paying for. Understanding these costs is essential for calculating your true investment returns and making informed decisions about your trades. So, I'll see you in the next lecture. Thank you. Welcome to our final lecture of section 3. We have gone through the exciting steps of setting up your account and learning how to trade. Now we need to talk about something a little less glamorous but incredibly important, the costs. In this lecture, we'll cover all the potential fees and commissions so you can never be a savvy investor who keeps more of your own money. So, free trading isn't always free. So, as I've told you, some mostly people don't charge any money over here. They charge only like zero commission. Only the taxes go when you trade something. So you see it advertised everywhere, commission-free trading, and this has been a wonderful development for individual investors like us. For the most part, it's true. You can buy and sell stocks without paying a direct fee, but it's not the entire picture. There are more subtle costs involved in investing, and our goal today is to make them visible. So, trading commissions. So, for usually stocks and ETFs, you can do it at 0 rupees. Majority online brokers are providing at zero. Some brokers still charge a fee to purchase mutual funds, especially funds from other companies. Always check before investing. Now, the expense ratio. This is perhaps the most important fee to understand, and it only applies to mutual funds and ETF. What it is? It is an annual fee um, that is charged by the fund company to cover their operating expenses, portfolio management, research, administrative cost, marketing, and more. So, this is how it is expressed. It is shown as a percentage of your total investment in the fund. The percentage is deducted automatically from the fund's assets. For example, expense ratio of 0.5% means you pay 500 per year for every 1 lakh you have invested in that fund. Now, why expense ratios matter? The invisible wealth killer. So for example, if you invest, starting investment is 1 lakh rupees and annual return rate is 10% before fees. So for example, if you have only 0.1% expense ratio, so 1 lakh rupees will grow to 7.6 lakh rupees over 30 years. But if the expense ratio is 1%, so you'll get only 5.7 lakh rupees for over 30 years. So you need to be careful what expense ratio they are charging you. Go for always the best one, because you'll end up saving a lot of money because of the compounding. See, 0.9% here difference will in 30 years create a lot of difference, right? So this is the graph you can see. This is with 1% and this is with 0.1%. As you can see, the growth is like massive, but it will not show in starting years. It will show in the later years. Now, what is a good expense ratio? Passively managed index funds, example Nifty 50 index fund, S&P 500 funds, look for expense ratio below 0.1%. Many excellent index funds now charge as little to 0.03 to 0.05%. Since these funds simply track an index, there's no reason to pay high fees. Now, how you can actively manage funds? So, expense ratios are higher when they're actively managed. It could be 0.5% to 1.25% or even more. These funds are more because they're actively managed and more R&D is supposed to be put into here. So portfolio managers try to beat the world, so they charge you more. Rule is that your job as an investor is to always know the expense ratio before you invest in any fund. Make it part of your research checklist. Now, bid ask spread. Bid price, the highest price a buyer is currently willing to pay for a stock or security. The spread, the tiny difference between the bid and the ask prices. This represents profit for market makers who facilitate trade. And there is ask price, the lowest price a seller is currently willing to accept for the same stock or security. For most large stocks, the spread is typically only a penny or two or a few paise, so it's barely noticeable for any typical investor making occasional trades. For less smaller stocks, for low trading volumes, they can have a wider spread. For example, a stock price is trading at 100 rupees. So in large cap companies, if you want to sell at, let's say, 100, but no one is available at 100, but there might be a lot of people available at 100.5. But where the volume is too low, so you might be wanting to sell at 80, but the buyer is at uh, you want to sell at 100, but the buyer may be at 80. So this is a long gap. So for smaller stocks, this is like very difficult. So this is all a game of liquidity. Smaller stocks are illiquid, so you end up paying, so you have a wider spread. So if you want to sell at 100 but the buyer is only available at 80, so there is 20 rupees. Either you wait or you book a either you book loss from your profit or loss whatever price you bought. Now there are other miscellaneous fees to watch for: account maintenance fee, inactivities fee, and account transfer fee. We could just skip this. You could just check before registering into any of this. So the golden rule of investing cost is that you get what you don't pay for. So lower fees can boost returns over 25% over 30 years. So even if it is 1% less, so it could boost your returns. So always check the costs. Now, section 3 recap. We have studied how to choose a broker, how to open and fund your account, and navigate the platform. We have also learned how you could place your trades, and we have also understood the fees. So, this was all in section 3. Now, next up, the fun part. We From section 1 to section 3, we have covered all the basics and we have taught you how you can place a trade and what exactly means buying a stock. Now you are officially all set up and ready to invest, right? So you have mastered the mechanics and logistics of investing. Now it's time for exciting transition from technical setup to investment analysis. In the next section, we are going to learn how to find and analyze great companies to invest in using fundamental analysis. Understanding that what makes a company financially strong and worth your investments. So we will be reading financial statements, evaluating companies' health, and valuation methods. So this is how these are the process which you can follow, and you could pick a perfect stock and invest in it. So I'll teach you how you can on your own study and research and through fundamental analysis pick a stock. So I'll see you in the next lecture. Thank you. Welcome to section 4. I'm so excited that you are in this section. So, in this section, we'll be talking about the fundamental analysis, how to find great companies. So, we have to think like a business owner and not like a gambler. So, let us begin with fundamental analysis. So, fundamental analysis is the systematic method of determining a stock's real or intrinsic value, what a company is genuinely worth beyond the market currently prices it at. This approach involves carefully studying everything that affects the company's value, from macroeconomics, trend, and industry dynamic, down to the company's specific financial health, management quality, and competitive positioning. So, what's this fancy term, fundamental analysis? At its core, it's a method for figuring out what a company is actually worth, its intrinsic value. This involves looking at all the fundamental factors that can affect its business, from the health of overall economy down to the nitty gritty details of all the financial statements. The ultimate goal is simple: to find a wonderful business that the stock market is currently selling at cheap price. Now let us take a detective analogy. You are the detective. So think of yourself as a financial detective. Price is just one clue. A stock's current price is merely one piece of evidence, not the complete picture. Now you dig deeper. Your job is to examine all the evidence and uncover the reality beneath the surface. So ask the critical questions. Are the sales growing consistently? Is the company profitable and generating cash? Does it have a strong, recognizable brand? Is the management team competent and trustworthy? So there are two schools of thoughts. Now, in the world of stock analysis, there are two major schools of thoughts. The first, which we are focusing on, is fundamental analysis. This is all about studying the business. The second is called the technical analysis. So, fundamental analysis and technical analysis. So, basically, what it means is that in fundamental analysis, we study the business itself, its operations, finances, and competitive position. Focuses on the why. Why is this a quality company worth owning? Time horizon, long term, in months, years, or decades. It seeks to understand intrinsic value and business quality. So basically, how the company is working, whether the quality of the company is good or not, and is it worth owning, like this. So our focus is this over here. In technical analysis, what happens is that it studies the price charts and patterns, historical price movements, and trading volume. So it focuses on the when. When is an opportune time to buy or sell? Time horizon is short term over here for days, weeks, and months. It relies on patterns, trends, and market psychology. For example, if a chart pattern is following such a trend like this, something like this. So, like this. So, next time when it comes over here, we know that it is going to go down. Now, when it is here, we are assuming it will go again up. So at this point we have to buy and we will sell over here at the high. So this is how technical analysis works. There are a lot of things we can do in technical analysis. Now our focus, fundamental analysis. In this course we concentrate exclusively on fundamental analysis because our goal is to build long-term wealth. So, through intelligent business ownerships, we are learning to be long term investors and not short term traders. There's a fundamental difference. Investors seeks to buy and own great businesses for years and decades, while traders attempt to profit from short term price movements. This patient business owner mentality is the same approach used by the legendary investors like Warren Buffett, who famously said his favorite holding period is forever. Like he wants to hold the stock forever. Now let us talk about the two halves of the fundamental analysis. So to thoroughly understand a company, we must examine it from two complementary perspectives. Think of this as combining art and science to get the complete picture. First is the qualitative analysis, the non numerical factors that define a company's character and competitive position. The company's story and mission, brand strength and reputation, quality and integrity of management, competitive advantages, and market position. The art of analysis. Quantitative analysis is the measurable factors expressed through financial statements and metrics, revenue and profit growth, debt levels and financial stability, cash flow generation, valuation ratios, and return. The science of analysis. So, quality and quantity. We have to focus on both. Qualitative could be like the company's story, mission, what is it's doing, what are their values, and everything about non numerical. And quantitative is all the measurable factors, like what's the profit and how much they do in revenue, what's the growth, something like this, cash flow, etc., etc. Now, let us talk about key questions a fundamental analyst asks. So, as we go through this section, we are going to be asking questions just like a detective would. Is the company making money consistently? Is the company consistently profitable? Is its revenue growing? Does it have a strong competitive advantage? Is its industry growing? Is the management team capable and honest? Is the stock price fair compared to its value? So we have to check all this. Now there are some key takeaways. Understanding true value. So fundamental analysis, the art and science of determining a company's intrinsic value, what it's genuinely worth independent of the market fluctuations. The detective mindset says that approach investing like a financial detective, carefully analyzing the business itself rather than simply reacting to price movements. We also have to look on long term perspective, and we also have to do the dual analysis, qualitative and quantitative. Next up, we are going to begin our investigation with the qualitative side of things. In the next lecture, we'll dive in how to analyze a company's business model and most importantly, its competitive advantage. I'll see you there. Welcome back. In this lecture, we begin our detective work by focusing on the qualitative analysis, the story behind the numbers. So, this is where we look beyond the numbers and try to understand the story of business. We learn how to analyze a company's business model and how to spot wonderful, powerful economic moat. So, what is qualitative analysis? Qualitative analysis is the process of evaluating companies through non numerical information. It is less about the spreadsheets and more about judgment and insights. We are trying to answer one big question: is this a high quality business? This approach helps investors look beyond the numbers to understand what truly makes a company successful and sustainable in the long run. Now, the key area one is that the business model. Understanding is key. First, you must understand how the company makes money. If you can't explain in simple sentence, you shouldn't invest in it. Google example. Google makes primarily by selling high targeted advertising. For Starbucks makes money by selling premium coffee and food at high profit margins. So this is how they make money. You should be clear how they make money. What is the business model? Next key area that you must look is that competitive advantage, the moat. This is one of the most important concepts in investing, coined by Warren Buffett. An economic moat is a durable competitive advantage that protects company from competitors, just like a moat protects a castle. So, a wild moat allows a company to maintain high profitability for a long time, creating sustainable returns for investor. So, we have to check like how the company protect its from its competitor. Is it a very easy business or not, whether there is some entry barrier or not, whether it is capitalism or it is great R&D and D and stuff. Nowadays R&D doesn't also work because reverse engineering happens. If you have the product, people just open up your product and figure out how the product is made, and then they can just copy your product. So how you can beat your competitors. Now, types of economic modes: brand strength. So for Apple, people say a premium for the iPhone over similar phones. The Apple brand commands loyalty and higher prices. So customers are willing to pay more for a trusted brand. It creates pricing power and customer loyalty that competitors struggle to overcome. Now we have Coca-Cola. It is a brand, is recognized globally and inspires loyalty across generations and cultures. Nike, the swoosh is a powerful symbol of quality and performance in athletic wear. Now, types of economic modes: network effects, the power of connection. A product or service becomes more valuable as more people use it. This creates a winner take all dynamic that's incredibly difficult for competitors to overcome. For example, Facebook and Instagram, you use it because all your friends use it. The value grows exponentially with each new user. Also, Visa and MasterCard. Merchant accept it, so many customers have it. And customers have it because so many merchants accept it. So these are all the network effects. This is the power of connection. Now, talking about the economic modes, switching costs. So it is too expensive, time consuming, or difficult for a customer to switch to a competitor. This friction creates customer retention without requiring ongoing marketing efforts. For example, your bank. Moving all your direct deposits and automatic payments is a huge hassle. Most customer put simply because switching is too painful. Also, for Microsoft Windows, all your software and files are built for it. Switching to Mac is a major undertaking require new software, learning and data migration. So, switching cost, people usually don't want to do all the hassle for switching, so they stick to just one kind of brand. Now, the key area 3 is the management team. So, are the leaders of the company, like the CEO, CFO, smart, honest, and capable? You are betting on the jockey as much as the horse. You should have the track record of success. Look for leaders with a proven history of navigating challenges and delivering results over many years. Now there is a clear vision for the future. Great leaders articulate where the company is headed and how will it get there with strategic clarity. Skin in the game. Do they own a lot of company stock? This means their interests are aligned with as your investor. If they have like a very lower share in the company, they might be not interested. If they are having their equity or their portfolio is diversified such that their interest is somewhere else, so they might not be focusing on the company. Now there are some key takeaways: quality over quantity. Qualitative analysis is about judging the quality of the business, not just looking at numbers. You have to understand the model. You must be able to simply explain the business model in one clear sentence. Find the moat. The most powerful companies have a wide economic moat, competitive advantage that protects profit. Now, leadership matters. A great management team is essential for long term success and sustainable growth. Next up, from art to science. We have covered the art of analysis, and now it's time for the science. In the next lecture, we'll dive in to the quantitative analysis and learn about the key numbers and tell the story of a financial company's financial health. So in next lecture, we'll be discussing quantitative analysis, and I'll see you over there. Welcome back. We have just learned about the qualitative analysis, judging the story of a business. Now we are going to switch gears and learn the science, quantitative analysis. This is where we look at the hard numbers and see if they support the great story we just uncovered. So let us talk about what is quantitative analysis. This is the science part of a detective work. It involves examining a company's financial statements to evaluate its performance using concrete measurable data. Think of it as a gathering device. If the qualitative story represents the claim about a company's potential, the quantitative numbers provide the proof that validates or challenges that narrative. Now, the three core financial statements. First is the income statement. So, all the data comes from the three main documents that every public company is required to file. They are the income statement, the balance sheet, and the cash flow statement. So, income statement reveals whether the company was profitable over a specific period of time or not, such as a quarter or a financial year. It tracks revenues and expenses. Then we also have the balance sheet, which tells how much the company owns assets and what it owes liabilities. So at a single point in time, it shows company's financial position. Also, the cash flow statement tracks all the actual cash moving in and out of the business, showing how the company generates and uses cash in its operations. So from all this, we can see if the company is profitable or it is in loss, right? So we will explore each of these statements in detail in a dedicated section later in the course. For now, let's focus on key metrics. You don't need to be an accountant to be a great investor. You simply need to understand a few key numbers that tell you most of the story. Let's examine the most important metrics that every investor should know and understand. So, key metric one is revenue, that is sales. So, now let us understand what is revenue. Revenue is the total amount of money a company generates from selling its goods or services. It is often called the top line number because it appears at the top of the income statement. Now, the critical question to ask is the revenue growing consistently year after year? Steady revenue growth demonstrates that there is a strong and increasing demand for the company's products or services in the marketplace. Next, we have the key metric two, that is net income profit. Is firstly nowadays days there are a lot of startups, so we need to take care that if the company is profitable or not, we have to check. Then we have to see what is net income. Net income represents the company's total profit after all expenses have been deducted. This includes the cost of manufacturing products, employee salaries, taxes, interest, and operating expenses. It is called the bottom line. Why? Because it appears at the bottom of every income statement. So revenue comes here, then come all other costs, and whatever is left at the bottom is profit. That's why this is the top line and profit is bottom line, right? Now, the questions to ask, is the company actually profitable and is the profit growing over time? Consistent profit growth is a strong indicator of financial health. Now we have revenue versus profit and analogy. For example, you sell 100 cups lemonade at 50 rupees each. Now your total revenue is 5,000 as 100 into 50. Basic maths, 5,000 is your revenue. Now expenses, but you had to pay 1,500 for the lemons, sugar, cups, and other supplies. So revenue minus expenses will be a net profit. So our net profit is 3,500 and our revenue was 55,000. So this is very simple, but in a company there are like lot of costs. So you need to just take care of that. Now key metric 3, that is earnings per share, EPS. So understanding EPS means that EPS is the company's total net profit divided by the number of outstanding shares. It tells us how much the profit is attributable to a single share of stocks. This is one of the most common metrics used by analysts and investors to judge a company's performance and compare it with competitors. The critical question, is EPS growing consistently over time? Rising EPS is generally an excellent sign of companies improving profitability and shareholder value. Now, key metric debt. Where to find it? Debt information appears on the balance sheet, showing the company's short-term and long-term borrowings. Is debt always bad? Almost all company carry some debt, and which is completely normal and often strategic. Debt can fuel growth if used wisely, but there's also a risk factor. However, the excessive debt can be very risky, especially during economic downturns when revenues decline and debt payments become burdensome. So the question to ask is that, is the company's debt level manageable when compared to its total asset and annual profits? Look for a healthy balance. Now the key takeaways are revenue, That is sales, we have discussed. Is the business growing? How much the revenue shows expanding market presence and customer demand. We also have net income, that is profit. Is the business actually making money? Profitability is essential for long term sustainability. We also have to see earnings per share. Is the profit per share growing? Rising EPS indicates improving returns for shareholders. We also have to check the debt levels. Excessive debts might increase risk also. So these are the numbers that provide us the concrete proof and evidence for our investment thesis, transforming qualitative observations into quantitative validation. Next up, raw numbers are useful, but they even become more powerful when they put them in proper contrast and compare them intelligently. In the next lecture, we'll learn how to use financial ratios to make smarter comparisons between companies and gain deeper, more meaningful insights into their true performance. These ratios will help you to understand not what the numbers are, but what they mean for your investment decisions. So, this will take our analytical skills to the next level, and I'll see you over there. Welcome back. We have learned about the key numbers like revenue and profit. In this lecture, we are going to learn how to turn those numbers into investors' secret weapon by using financial ratios. Ratios are what allows us to add context and make smarter comparisons. So, why use ratios? Raw numbers lack context. If $1 billion rupees in profit impressive, the answer isn't straightforward. It entirely depends on the company's size and industry. So ratios enable comparisons. How much ratio is known for a small startup? 1 billion rupees is extraordinary achievement. For a tech giant like Apple, it signals serious trouble, right? So the first ratio that we have to look upon is that net profit margin. So we have to measure profitability. What it measures? The percentage of revenue that translates into actual profit, showing how efficiently a company converts sales into earnings. So that gives us net profit. So the formula is that net income divided by revenue. So the simple calculation reveals operational efficiency at a glance. So what to look for? A high and stable margin, or better yet, one that's steadily growing over time. Consistency matter as much as magnitude. For example, we have a company. Let's say its net income is 10 rupees and the revenue it's doing is 100. So we'll do 10 by 100 into 100, which will give us 10%. So the profitability over here is 10%. A retains 10 rupees as pure profit after covering all expenses, taxes, and costs. This 10% margin can now be compared against competitors and industry benchmarks. Now, talking about the ratio 2, that is PE ratio. So, PE ratio means price to earning ratio. Stand as the most widely recognized and debated valuation metric in investing circles. So, what it reveals? It reveals how much investors are willing to pay for every 1 rupee of company's annual earnings. It is essentially market's confidence score. The calculation is done such that stock price per share divided by earnings per share. So both figures are readily available on financial website. So investment insight, it tells you whether a stock is expensive or cheap relative to profit it generates, but context is very critical. Let's take an example. PE ratio side by side comparison. So stock A, the share price is 5 rupees and the earning per share is 5 rupees. So the PE ratio over here is 20. People are willing to pay 20 times whatever the earning is per share. Whereas here the share price is 40 and the earning per share is only 1 rupee. So here the PE ratio is 40. People are willing to pay 40x per share earning, right? So people are paying 20 rupees for every 1 rupee of annual profit. This suggests that moderate market confidence in future growth. And investor are paying here 40 rupees for every 1 rupees of profit. So this is indicating very high growth expectations or potential overvaluation. So it does not mean that always that it has very high growth. Sometimes it is overvalued and the market might correct itself, and then the share price might come down to its actual value. So PE ratio generally till about 50 it is safe. If it's above 50 you must take care and do all the research again, because above 50 is like very risky. Now, what is a good P ratio? Lower is generally cheaper, but it's never that simple. Context is everything in valuation. Essential comparisons. Historical benchmarking. Compare the current P ratio to the company's own historical range. Is it trading above or below its typical valuation? Peer comparison. Examine the PE ratio of direct competitors in the same industry. Relative valuation matters more than absolute numbers. So industry context also matters. What is going to be a good PE ratio? Now, talking about ratio 3, that is to equity, measuring financial leverage. We have to understand the financial risk. This ratio reveals how much a debt company carries compared to its shareholders' equity, essentially, how much the business owes versus what it truly owns. So, this could be just total debt upon shareholders' equity. So, the calculation is simple: divide the total debt um, by shareholders' equity to get a single number that represents leverage. Now, it gives risk indicator also. This metric serves as a key indicator of financial risk. High ratio means more debt relative to equity. And safe territory, a ratio below 1.0 is generally considered quite safe. The optimal levels vary significantly industry to industry. Now we have studied like what are the profit margins, reveals operational efficiency and profitability. Higher margins indicate better cost control and pricing powers. P ratio shows us the market valuation relative to earnings. Always compare to historical averages and peer companies. Debt to equity measures financial risk and leverage. Low ratios generally indicate safer and more stable companies. These powerful tools help us move beyond more data collection to genuine investment insight and informed decision making. So, this is all how you could, deal with all the data and make a decision, qualitative, quantitative, and how the quantitative data is supposed to be, taken into account to make your financial decisions. So, next up is finding the data. Now the data, you understand what to look for, where do you actually find these financial metrics. In our final lecture of this section, I'll show you where you can exactly get access to all this data completely free from reliable online sources. So you'll discover the best websites, how to navigate financial statements, and practical tips for efficient research. I'll see you over there. Thank you. Welcome to the final lecture of section 4. We have learned all about the clues we need to look for from economic modes to PE ratio. In this lecture, we'll answer the final critical question: where do we actually find all the information? I'm going to show you the best free and reliable resources for your detective work. So, where do we find this information? So, we have our shopping list of data points. Now we need to know which store to go to. The good news is all the information we need on public companies is by law available to the public. We just need to know where to look. We'll talk about two types of sources: the official primary source and the more user friendly secondary source. So, the primary source is like the SEC fillings. Um, it is the most official source of information is the company's own filings with the SEC in the Securities Exchange and Commission. In India, we have SEBI. All the data we can get from there. That is the raw and unfiltered data straight from the horse's mouth. It is the most reliable information because companies face severe legal penalties if they lie in these documents. Now, the two most important fillings. It's the form 10K, that is annual report. So you can find it over there. It varies from country to country. And 10Q is quarterly report. So it is a smaller quarter update, and this is a yearly update. So while these best sources, they can be very long and dense, filled with legal and accounting jargons. So the secondary source is financial websites. So there are a lot of uh, websites where you can find all these data in simple written language and more user friendly. It's a secondary source. So these are financial websites that do the hard work of pulling all the data from these long SEC filings or SEBI filings and presenting it to you. Easy to read charts, graphs, and tables. For 99% of your research, these free websites are all you ever need. So you could use Yahoo Finance, Google Finance, or even broker platform provides you news. Now, you could just, finance.yahoo, you could search for that company and you could explore the company page, whatever I told you. You can also find the summary page. And in the summary page, what do you need to look for is these are the key informations available in any of the page. That could be the current stock price, real time or delayed pricing, P/E ratio, that is valuation metric, and we also have earning per share, that is EPS, profitability indicator. Then we have market capitalization, company's total value, and 52-week range, highest and lowest prices. Now we can also check out for the dividend yield, that is income potential. For example, um, the share is for 100 rupees and they earned 1 rupee for each share. So this profit is supposed to be given to the shareholder. So for every 100 rupee, if 1 rupee is the profit, so and if the profit is just lying, it is not being reinvested in the company or something like that, so it will be given to the owner, right? Now, there are some interactive features also. The page includes an interactive price show, something like this data, all the graph and all. So, from 1 day to 5 years or more, look for the PE ratio and EPS prominently displayed in the right hand column of key statistics. Now, the financial tabs. This is where you will discover the detailed numbers we have discussed throughout our series. The financial tab is essential for fundamental analysis, the income statement, the balance sheet, annual or quarterly view. Now the statistics tab. In statistics tab, what you mainly have to find is this: profit margin, debt to equity ratio, return on equity, efficiency in generating returns, price to book ratio, valuation relative to net assets, beta, shock volatility compared to the market, forward PE, valuation based on projected earnings. Now your homework is to that. Just pick a company and visit any website and find the key metrics and study for all. Like what are their P ratio, what is EPS, and all the terms. What is their profit margin, and etc. etc. And you must document your findings. So in section 4, first we covered the qualitative analysis. You can evaluate a company's business model and how it is done, what are its values, and all the non numerical data. Then we have quantitative metrics. You understand the key financial numbers, including revenue, profit, earning per share, and cash flow. Then we have some financial ratios that convert that quantitative metrics into ratios like PE, profit margin, and debt to equity for contextual analysis. Then these are the data sources from where you can get the data and work upon it. So this was the section 4 recap that we did. Next up, putting it all together, we have assembled everything. So you know how to read the financial statements, how you can do deeper interpretation from those financial statements, reading between the lines and spotting trends. Now you are a confident analyst making informed investment decisions. So in the next section, we'll explore how to read and interpret the three core financial statements in greater detail, transforming you into a truly confident and capable analyst. I'll see you in the next section. Welcome to section 5. In the last section, we learned the key metrics to look for. Now we are going to learn Where to find? By reading the financial statements themselves. This skill will transform from someone who just look at the stock prices from someone who truly understands the business behind the stock. We are going to learn the language of business. So the financial storybooks. Every public company tells its financial story through three main statements. Um, that is the primary statement we use. That is the quantitative analysis. They are essentially the language of business. Mastering these statements allow you to understand how companies generate revenue, manage resources, and create value. Each statement answers a different but interconnected question about the business. The three statements, an analogy. To make it simple, let's use an analogy. The income statement is like a school report card for a semester. It tells you how the well has company performed over time, like a quarter or a year, right? The balance sheet is like a single snapshot taken on a graduation day. It tells you the company's financial health and that one specific movement. Then comes our cash flow. So, cash flow, like a video of the semester, it tracks all the cash moving in and out of the business throughout the period. Right now, talking about the income statement, the question it answers: was the company profitable? What it shows: the income statement displays company's revenue, expenses, profit over specific period, typically a quarter or a year. Sometimes it is also called the profit and loss statement. So bottom line is the income is the initial final figure. You whether the company made money after all expenses or not. Now comes the balance sheet. What is the company's financial position? A snapshot of assets and liabilities. We have already discussed it. So assets is equal to liabilities plus equity. The fundamental equation must always balance. Now talking about the cash flow statement. Operating activities. Cash from daily business operations, the core revenue generating services. Now, there are also investing activities, cash used for or generated from investment in assets like property and equipment. Now, there are some financing activities, cash from borrowing, repaying debt, or issuing shares to investment investors. The bottom line is that the net change in cash shows whether a company's cash position improved or declined during the period. How they connect. These three statements are not isolated reports, they are deeply interconnected and tell one unified story about the business. Income statements to balance sheet. Net income flows into the balance sheet, retained earnings, increasing company's equity. Now, there is cash flow statement connection. The cash flow statement starts with the net income and reconciles it with the actual cash balance shown on the balance sheet. Now, here's the complete picture. Together, they provide a comprehensive 3D view of business, financial health, and performance. So, this one might be most important and the most misunderstood. It answers questions: where did the cash actually come from and where it went? It tracks the real cash moved through the business, which can be very different from the profit shown on the income statement. It is broken down cash from operations, investing, and financing. Right. So, this is how they connect. Now, the key takeaways are here from this three core statements. Every public reporting uses these three interconnected financial decisions. That is the income statement, the balance sheet, and the cash flow statement. So, these are the things. Next up, we will deep dive into the income statement and understand everything about it. So, I'll see you over there. Welcome back. In this lecture, we are going to deep dive into the first and the most famous of the financial statements, the income statement. We're going to walk through it step by step, from the very top line down to the very bottom line. So, the story of profitability. The entire purpose of the income statement is to tell the story of company's profitability over a set period, like a quarter or a year. The best way to visualize it as a staircase. We start at the top with all the money company brought in. and which each step down we subtract another category of costs until we are left with the final profit line. So for example, we had revenue over here, then these are all the costs that are detected, and here we have either profit or we have loss. So this is how it works. Now the lemonade stand income, let's take to make this real, we're going to build a simplified income statement from our trusty lemonade stand. Let's imagine we are looking at this performance for a single month. So line 1 is going to be the revenue, that is going to be the top line. For example, we sold 1000 cups at 2 rupees each during the month, so our revenue is 2000 rupees. So here we have 2000 rupees in this lemonade stand. So we know already what is revenue, we don't need to discuss it here again. Now comes second line, that is cost of goods. So COGS, this is a very popular term, that is cost of goods sold. So COGS represent the direct costs required to create the products you sell. These are the expenses that fluctuate with the production volume. The more you produce, the higher these costs. So for example, let's say the total material is 500 for a month. So we have to deduct 500 as COGS. Now line 3 will be our gross profit. So revenue was 2000, COGS we have subtracted minus 500. The net we got 1500 is gross profit, right? So for example, there could be operating expenses like marketing, flyers, social media ads, something like this. We also have to give salaries, wages paid to the employees or helpers who serve customers, and also the rent for the stands location or rental space, something like that. So for example, we have total 800 rupees expenses for the month. So now from the gross profit, we are going to deduct 800 rupees. Now we have operating income, the net result. So operating income basically means gross profit minus operating expenses. So operating income we have here is just 700 rupees. 1500 minus 800, which leaves us with 700. So 2000 was a revenue, 500 was COGS, then 1500 we got as gross profit, and 800 is operating cost. So now we are left with operating income, that is 700. Now there are some interest and taxes. So company pay interest on borrowed money, loans, bonds, something like that, or credit lines used to finance operations or growth. And there are also tax expenses. Businesses must pay income taxes to the government based on their total profits. So let's take a random number. Let's say 100 rupees was interest and taxes. So from operating income, we have to deduct this 100 rupees. Now what we are left with is net income, that is 600. This is the bottom line. So it is also called as profit. So this is the bottom line. Since revenue is always known as the top line, and the net income is always known as the bottom line. Right, so we have 600 rupees over here, which is our profit. So revenue was 2000 and we deducted everything and finally came down to 600 rupees. So what to look for as an investor? Trends are everything. So is the revenue growing year after year? Consistent revenue growth indicates strong demand and market position. Look for steady upward trajectories rather than volatile fluctuations. Also, is the margin improving or not? Is the profit increasing or not? We have to also check that. And consistent profitability. Is the company consistently profitable quarter after quarter or year after year? This demonstrates that the profit is steady and the company is steady and it has a sustainable business model. Now, the key takeaways are that the income statement as a story. It narrates the journey of profitability starting from the top line and descending through various costs to reach the bottom line, that is the net income. Each line reveals efficiency. So, all the production efficiency, operational management, overall profitability. We get to know about everything. Now we have to focus on the long term trends, look for positive sustainable patterns in revenue growth and profit expansion over multiple periods, not just single quarter results. Right? So, here we discussed all the income statement, and what was the revenue and how we got the profit, or it may be loss. So, the top line and bottom line of the income sheet. Next, we have the balance sheet, which we are going to study in detail in the next lecture. So now we know whether the company was profitable during a specific period, but what about its overall financial health and stability? In the next lecture, we will analyze the balance sheet to understand what the company owns assets and what it owes liabilities, and the residual values belonging to shareholders, that is equity. This will give you a complete understanding of company's financial position and give you the full picture needed for informed investment decisions. I'll see you over there. Welcome back. We've just learned how to measure a company's profitability with the income statement. Now we are going to see about the balance sheet, which gives us a snapshot of the company's overall financial health. So, a snapshot of financial health, we'll be looking at this. The story of financial position. Purpose of the balance sheet: to show a company's financial position at a single point in time. For example, 31st of December of 2024. It's a snapshot. It's not about performance over a period. It's a frozen movement capturing the company's what it owns and what it owes. The unbreakable rule. It is governed by one fundamental equation that must always hold true no matter what. That equation is assets is equal to liabilities plus shareholders' equity. This must be always in balance. Every balance sheet you'll ever look at for any company in the world will be built on this foundation. The two sides must always balance to penny. So let's define what each of these three terms means. Now let's talk about the part one, that are the assets. Now, what are assets? Assets are simply everything of value that the company owns. This is all of its resources. It includes obvious things like cash in the bank, the factory, and the equipment it uses, and the inventory of the products sitting in its warehouses. It also includes money that its customers still owe it. So, these are all the things which are assets of the company. Now, talking about the part two, that are liabilities. What are liabilities? On the other side of the equation, we have liabilities. Liabilities are everything the company owes to other people, right? So, these represent company's debts and financial obligations that must be settled. Some bank loans, money borrowed from financial institutions that need to be repaid with interest over time. Accounts payable, money owed to suppliers for goods or services purchased on credit. And salaries payable, employee wages and salaries that have been earned but not yet paid out. Now we have shareholders' equity. Shareholders' equity represents the company's net worth. It it's what it would be left over the shareholders if the company sold all its assets and paid off all its liabilities. So assets minus liabilities is equal to equity, also called book value. It represents the true ownership stake company. Growing equity indicates the company is creating value over time. Now let's build a balance sheet. For example, we have cash in the register as 800 rupees and lemonade stand equipment as 200. So total assets we have is 1000 rupees, right? So we have cash and then we have the equipment. If I go and sell that equipment today, I would get 200 rupees. On the other side of the equation, what we owe. So let's example we took a loan from mom and dad. That would be like 100 rupees for the starting up, and we have total liabilities 100. So now owners investments plus retained profits. So our total equity is 100 because 1000 we had as assets and liabilities we are going to subtract. So net we are going to get 900, which is shareholders equity or net worth. Now does it balance? Yes, liabilities plus equity is equal to 1000 and assets is equal to 1000. So we had this formula: assets is equal to liabilities plus equity. Now, what to look for as an investor? Strong cash position. Does the company have enough cash reserves to handle a tough year or unexpected challenges? Adequate liquidity is essential for survival. Also, does it have like manageable debt? All the liabilities small relative to the asset and equity. We use the debt to equity ratio to assess like the debt is must be like much lower than the equity, so the ratio must be very low. Growing equity, is the company's net worth equity increasing year on year? This is a great sign that the company value is being created for the shareholders. Now, key takeaways is that a snapshot in time, the balance sheet shows what a company owns and owes at a specific point in time. And this is the unbreakable rule: assets is equal to liabilities plus equity. The fundamental equation must always balance, ensuring accounting accuracy. This gives us a financial health indicator. It gives you a clear, comprehensive picture of company's financial strength and stability and risk level for informed decision. Right. Next up, following the money. Um, so we have examined the report card, which is the income statement, and the snapshot balance sheet. Now it's time to watch the video. In our final lecture of the section, we explore the statement of cash flows, where we track how money actually moves in and out of business. So, understanding cash flow is the understanding of the lifeblood of any business. So, that topic is critically important. Statement of cash flows. See you there. Welcome to our final lecture of section 5. We've read the company's report card and we have seen its financial snapshot. Now it's time to watch the video and follow the money by analyzing the statement of cash flows. So, the story of cash. The purpose of the cash flow statement is to track every single dollar that actually entered or left the company's account over a period of time. This is critically important for one key reason that confuses many people: profit is not the same thing as cash. We have to understand the basic difference between profit and cash, the critical distinction. Income statement reality. So let me give you an example. Imagine your company makes a huge $1 million sale to a big customer. The accounting rules say you can book that as revenue and profit in your income statement right away. You look very profitable. But what if that customer has 90 days to pay you for the next 3 months? You have zero cash from that sale. You can't use that profit to pay your employees or rent. That is why we say cash is king. A business lives and dies by the cash flowing through it. And the statement here we track it. Right. So there are three sections of this statement: cash flow from operations, cash flow from investing, and cash flow from financings. So first let us start with CFO. That is cash flow from operations. The lifeblood of the business, cash generated from core daily activities. To make it easy to understand where the cash is coming from and going, the statement is broken down in these three simple things. So, first, let us talk about cash flow from operations, CFO, the most critical section. The first section, cash flow from operations, this shows all the cash generated by company's core day-to-day businesses. For Starbucks, this is the cash from selling coffee. For Ford, it is the cash generated from selling cars. For a healthy, sustainable business, we want this number to be strongly positive and ideally growing every single year. This is the engine room of the company. Now, talking about the cash flow from investing, which is CFI. So, understanding the negative. This section shows cash used for investments to grow the business. It is usually negative for a healthy, growing company. That is actually a good sign of strategic expansion. So, common investment activities could be buying new equipment or buildings, cash outflow, negative number, selling old assets, acquiring other companies to expand market presence, and purchasing investments in securities or other financial instruments. Now, cash flow from financing, CFF, cash inflows and cash outflows. Taking out a new loan from banks or financial institutions, issuing new stock to raise equity capital from investors. Now, here are some cash outflows: paying back debt principal to reduce financial obligations, paying dividends to shareholders as a return on their investment. Now, buying back company shares from the market. So, this is how we could do. So, cash will inflow if we take a loan from any financial institution, if we issue a new stock to raise equity from investors, and if we are paying back debt or all the spendings, that will be counted in cash outflow. Now let's put this all together. So cash flow from operations, typically positive cash inflow, and cash flow from investing is typically negative outflow, and cash flow from financing could be negative or positive. So the positive cash from operations plus the negative cash from investing plus or minus the cash from financing gives us the total net change in the company's cash for that year. And that number perfectly explains the change in the cash balance on the company's balance sheet from one year to next. So CFO is typically positive and CFI is typically negative. CFF can be either, and this is the net change in cash in the company. Now, what to look as an investor if strong and growing CFO is there and we have free cash flow. So, as an investor, your main focus should be on the first number, cash flow from operations. You want to see a business that is powerful cash generating machine. From this statement, analysts also calculate free cash flow, which is the cash business has left after all the necessary investments. This is the spare cash that can be used to really reward shareholders, and it is a sign of very strong business. Now we have completed section 5. Let's take a recap. First, we studied what is the income statement. Then we studied the balance sheet. Then we have studied the cash flow statement, and then we had the complete story. So, income statement shows us the profitability over time, how much the company has earned and spent. Then there is balance sheet, shows financial position at a specific point in time, what the company owns and owes. Now, then there is the cash flow statement, tracks the actual cash movements, where the money came from and where it went. And lastly, we did the complete story. You understand how all three statements connect to paint a comprehensive picture of business health. So the next level is going to be combining analytical approaches. We have learned the difference between fundamental and technical analysis, but what if we could harness the power of both approaches together? In the next section, we'll explore introduction to the world of technical analysis to see how chart patterns, price movements, and trading indicators can complement our fundamental research for more informed investment decisions. I'll see you there. Welcome to section 6. So far, our entire focus has been on fundamental analysis, finding great businesses. In this section, we are going to introduce you to the other major school of thought, that is technical analysis. So, I want to be clear from the start. We are not trying to turn you into day traders. We are going to learn the basics of reading the charts so you can use it as a powerful secondary tool to improve your investment timing. Now, let us understand what is technical analysis. So, technical analysis is the systematic study of price movement and trading volume, represented visually on charts. Unlike fundamental analysis, which examines a company's financial health and business model, TA focuses exclusively on the chart itself. So, all the bar graph and all the charts which you see. So, the core belief of a technical analyst or a technician is that all the information you could ever want to know about the company is already reflected in its stock price. So, instead of reading financial statements, they read the chart. Now, let us take a quick recap. Let's put this context of fundamental analysis and technical analysis. So, the basic thing is that fundamental analysis tells us what to buy, and technical analysis tells us when to buy. So it studies all the financials, business health, focus on intrinsic value, etc., etc. But technical analysis studies market psychology through charts, focuses on price trends and chart patterns. Time frame for short term approach, but for fundamental analysis, it is for long term approach. So this is the basic difference. So it examines balance sheet, profit margins, competitive advantages, etc. It analyzes support, resistance, and momentum indicators. Now, talking about the three core principles of technical analysis, the market discounts everything. All available information is already reflected in price. Price moves in trends, price follows directional patterns that tend to persist. Also, history tends to repeat itself. Human psychology creates recognizable, recurring patterns. So, they search for patterns and all the trends, how the chart is moving, and according to that, they place their trade. Now, principle one, the market discounts everything. So, this first principle is the big one. It is the idea that at any given point, a company's stock's price reflects the sum total of all known information. This includes the fundamentals, the economic outlook, and the hopes and fears of millions of investors. A technician believes that because all this is already priced in, there is no need to analyze it. You only need to analyze the price itself. Is the price at which we are buying is correct or not? Now we talk about principle two, that is price moves in trends. So there's uptrend, which we call the bull market when the market is going up, and then there is downtrend, which we call the bear market when the graph is going down. And there could be sideways consolidation. The stock moves in a range and it stays at a in a particular range. This is a high and this is a low. So they move before a breakout. And what does breakout means? For example, if a stock is moving like this in this range, now if it crosses this, so here it broke out. So this is how price moves in trends. Now, principle 3, history tends to repeat itself. This principle recognizes that human psychology drives market behavior. So people basically they put their trades based on the previous historical data they have. So because charts are a reflection of human psychology, they and human emotions, especially the big two in the market, fear and greed, are predictable. People tend to react at the same time in at similar situations, and this creates recurring patterns on the charts that give us clues about the future. For example, if the market is crashing, everyone is in fear and panic, so they try to sell off everything, and whereas smart traders buy all the stocks at discounted prices. Now let us understand invested versus traders. So I'll also tell you about trading also. So right now, as a beginner, you must be an investor. Our primary identity is as long-term investors focused on building wealth and steadily throughout quality businesses and compounding returns. Day traders use technical analysis, and the success ratio is very low in day trading. So as a beginner, you should not be day trading because you will end up losing money. And our strategic goal is to basically use technical analysis principles as a complementary tool for right now. Once you are experienced in the market, you can go for day trading also if you would like to take like enormous amount of risk, and if you could beat all the market and make money. Now the key takeaways from here is that what technical analysis studies, it focuses on studying price charts and trading volumes rather than a company fundamentals or financial statements. There are three core principles which we spoke about, and that market discount all information, price moves in identifiable trends, and historical patterns repeat due to consistent human psychology. Our application for long term investors is that TA is a secondary but valuable tool that helps us with the crucial timing of our investment decisions, when to buy and when to sell. So Remember, technical analysis doesn't replace fundamental research, it enhances it by adding the dimension of market timing and sentiment analysis. So, next up, we will be reading candlestick charts, how technical analysis is done, and how charts are read. So, you'll understand the philosophy behind technical analysis, and it's time to learn the practical skill of chart reading. You must be, um, able to read all the charts. So, I'll see you there. Thank you. Welcome back. In this lecture, we are going to learn the language of charts by focusing on the most common format used by traders and investors everywhere, the candlestick chart. By the end of this lecture, you will be able to look at the chart and see a story, not just a bunch of random things. So, why not a simple line chart? Line chart. So, let us talk about the basics. You have probably seen a simple line chart before, something like this. This is a line chart, so it moves in lines, right? So it is useful for getting a quick glance at the general direction of a stock, but it is very limited. It only shows you the closing price. A candlestick chart, on the other hand, this is a candlestick chart, right? So it provides you four critical pieces of information for each period. It's open, high, low, and close, right? So it tells you a lot of about human psychology also. So let us now understand the anatomy of a candlestick. So basically, this is a candle. Here is the wick of the candle, and here is the high that could be close, and this is the body of the candle. So let us break down. Each candle on the chart represents a single period of time, let's say 1 day. The thick part is called the body. This is like the thick part, and it tells us where the stock price opened and where it closed for the day. The thin lines sticking out of top and bottom are called wicks or shadows. They show us the absolute highest price and absolute lowest price that the stock hit during that day. So for example, if you have opened in the time frame of 1 day, so this is a candlestick. We have this wicks, and so this could be the high, this could be the low, absolute highest and absolute lowest. This is how it works. So you could set it in a time period that's day, week, month, or even just minutes or seconds, so that uh, ch- price chart moves accordingly. Now, bullish versus bearish candles. Usually, in TradingView or everywhere on the all major platforms, you could find bullish candles as green or white, but mostly it is green. So candlesticks look like this. So the closing price was higher than the opening price, indicating buyers dominated the session and pushed prices upwards. So interpretation from this is that. Um, so for example, how do we know the opening price was? So it might be something like this. A candlestick is shown like this, like this. Then no, it went over here. So this was the opening price, and buyers pushed it, and it went too high of this, and it closed at this point, right? It closed over here. And whereas a bearish candle, so it is usually red, and somewhere it is also black, but we will only follow green and red. So the closing price was lower than the opening price, showing sellers controlled the session and drove prices down. The interpretation from this is that fear and selling pressure dominated. Now the story a single candle can tell. So long body, short wicks, and short body, long wicks. So the shape of a candle also tells us a story. A candle with long, strong body and a very short wick tells you that it was a very decisive day. One side was clearly in charge. On the other hand, if you see a tiny body but with really long wicks, so long body and short wicks is something like this, and a short body and long wicks is this, right? So if you see a candle with a tiny body but really long wicks on both the ends, that signals that a day of great indecision. There was a huge fight between buyers and sellers, but it ended up in draw. Now let's talk about a basic bullish pattern, the hammer. So you must have seen the hammer. It is something like this, and then so this looks like a hammer. So this is a very basic bullish pattern hammer. It is a small body position at the top with a lower wick extending downward. So this is what I told you. So basically what happens is that sellers initially drove the price significantly lower during the session, but buyers fought back aggressively, pushing the price back to close near the opening level. So as we can see over here, first this was in a trend, and here we saw a hammer. So when we saw a hammer, so it indicated that the market is going to go up from here. So this is how it works. So it often signals a potential bottom or bullish reversal, suggesting that downward momentum may be exhausted and an upward move could follow. Now, for a basic bearish pattern, we have a shooting star. So it is a opposite of a hammer. So shooting star looks like an inverted hammer, like this. So the market psychology of this is that buyers initially pushed the price much higher, but sellers took control and drove the price back down, closing near the opening level or lower. So the trading signal we get from this is it often signals a potential top or bearish reversal, indicating upward momentum is weakening and downward move may be imminent. Now, time frames are key. So you could watch a daily chart, weekly chart, or a monthly chart. So everything has its own, significance. A day trader might look at a 5 minute chart where each candle is 5 minutes. For us long term investors, we want to zoom out. We will get the clearest signal by looking at weekly and monthly charts. This helps us ignoring the short term noise and focus on the major long term trends. Now, talking about the key takeaways, there are four critical data points in a candlestick chart, that is open, high, low, and close. Also, the color and shape tell story. The color bullish or bearish. So bullish is green and bearish is red. So and the shape of the body size and the wick length reveal the underlying battle between buyers and sellers and the emotional state of market. So simple patterns and powerful clues like hammers and shooting stars, they can tell you when a bullish trend is coming or when is a bearish trend coming. You could also match time frames to your strategy. Long-term investors should focus on weekly and monthly charts to see the big picture and avoid getting distracted by short-term volatility. Next up, we'll be talking about support, resistance, and trend lines. How you could, use technical analysis to set up your trade when you are a day investor or day trader, right? So I'll see you there. Welcome back. We have learned to read the individual candlesticks. Now it is time to zoom out and learn how to read the architecture of the entire chart. So drawing support, resistance, and trend lines, identifying the market's battlegrounds. So what is support? Support is a price floor. It is a price level where a stock has difficulty falling below because there is a high concentration of buyers waiting to enter the market. Think of it like a trampoline for the stock price. Every time the price approaches this level, buying pressure pushes it back up. Multiple touches at this level strengthen significance and making it a critical zone for traders to watch. Now, for example, if a chart is moving like this, then it goes again up like this, then it goes again, like again, and like this. So here, from this chart pattern, we will draw a support line that this is the price from where it is usually bouncing back again and again. So wherever now in future, if this price comes like say let's say down up, it went up, and let's say if it is coming down again here, so this is the point we need to buy because it is possible that it might again go up. So this is how it works. Now, we'll be talking about, so this is the support. Now resistance, as we had support, now we had resistance. Like for example, we had a graph like this. So we can see, if we have a graph like this, so we can see here is the resistance. Every time it tries to go up, it again come down because there are a lot of sellers at this price point. So it is a price ceiling effect, and resistance is a price level where a stock struggles to break above due to concentrated selling pressure from the market participants. So here sellers are dominating, and in support, buyers were dominating at a particular price. Now, the psychology behind support and resistance. So, what do we mean by this? So, these level work because of human psychology and memory with the collective market behavior. Understanding the trader's mindset is crucial. Now, the support is the second chance. Buyers who missed the previous opportunity now perceive this level as a second chance, and they can buy this at a favorable price. This creates a renewed demand and buying pressure. The memory of the previous successful bounces from this level reinforces confidence amongst buyers, strengthening the support zone. Also, talking about the resistance, it is the exit strategy. Traders who bought at high price previously are now eager to sell and break even or exit their positions without losses. This creates concentration of sell orders at resistance, making it difficult for the price to push through without significant momentum. Now, the role reversal principle. Role reversal principle. Now, for a really cool and important concept. What happens when a price finally breaks through a strong resistance level? The old ceiling becomes the new floor. The market psychology shifts, and that price level now becomes strong support level. The same is true in reverse. When a stock breaks down through a major support level, that old floor can become a new, very strong ceiling. So, what do we mean by this? For example, if a stock is has, let's say, this resistance over here. Now, once it will break out, so people will expect that this has now become a support, and when it will come back, it will come back over here. Then, when it will go again, it will come back. So now this acts as a support. Same with the case of support becomes resistance. Basically, if we have a stock like this and we have the support over here, now when it breaks, so now what will happen? Now people will consider this as a resistance, that the stock won't go above, so it will be like this. People assume this. So this is the role reversal, which is very important. Now, what are trend lines? We need to understand that. So support and resistance, they are horizontal lines. This could be the resistance, this could be the support. So they are horizontal lines. Trend lines are similar, but they are drawn on a diagonal. Their job is to clearly tell us the primary direction that the market is moving. There are three trends stock can be in: an uptrend, a downtrend, or a sideways trend. So, uptrend is characterized by rising prices with higher highs and higher lows. For example, such a graph, this is a increasing graph. So this is uptrend. So we have higher highs and higher lows. So this was the low. Now again the low is greater than the previous low. This low was greater than the previous low. So this is the uptrend, and high points are also higher. Downtrend, the reverse of the uptrend, defined by falling prices with lower highs and lower lows, signaling bearish pressure. So downtrend will have lower highs and lower lows like this, whereas upper trend will have higher highs and higher lows. Now there is also a sideways trend. Price moves horizontally within a range, showing indecision between buyers and sellers. The price may be like this, right? So it is same. So these are the trend lines which could be drawn. So here the trend line is drawn like this. here the trend line will be drawn something like this, and here it, since it is sideways, so it will be nearly horizontal. So we've already talked about the uptrend, higher highs and higher lows. Also, we have spoke about downtrend, navigating the bear, how downtrend structure and how we can draw lines, and dynamic resistance. Now, the key takeaways from this lecture is the support, the price floor, resistance, the price ceiling. We've also understood the role reversal principle, and trend lines reveal direction. So next up, we have technical indicators. Master the basics, add confirmation tools, and enhance your analysis. So you've learned to identify key price levels and trend directions. Now you could add confirmation tools. You could put technical indicators and find out whether it is like you need to be double sure before placing a trade. So you could use that also. So I'll see you there. Thank you. Welcome back. We have just built the foundation of chart with the support, resistant, and trend lines. Now we are going to add a couple of gauges into our dashboard. In this lecture, we'll look at a few most of the popular technical indicators. These are tools that give us an extra layer of insight into what the price is doing. So now let us talk about the technical indicators. So what is an indicator? It is just a set of mathematical calculations based on the stock's price or volume. The stock is then plotted as a line or graph on our chart. The most important thing to remember about indicators is that they are almost all lagging. They don't predict the future, they are a result of what have actually happened in the history, right? So most indicators are lagging. They are useful for confirming a trend, not forecasting one. So now let us talk about the first indicator, that is moving average. So what it does is that its job is incredibly simple. It smooths out the chaotic day-to-day price movements so that we can see the underlying trend more clearly. It does it by creating a single flowing line that represents the average price over a certain period. Now, why it matters? One of the simplest and most popular indicators used by traders worldwide. The 50-day and 200-day simple moving averages, which is SMA. So there are many different types and lengths, but you'll hear about the 50-day and 200-day simple moving averages, SMA. So what happens is this: the 50-day shows us the medium term trend, while the 200-day shows us the long term trend. For long term investors, 200-day moving average is a critical line in the sand. When a stock is trading above 200-day moving average, its long term health is generally considered to be bullish. So it is just about the 50-day and it is about the 200-day. Now, there are moving averages as dynamic support and resistance. So, the power of moving averages. In a strong trend, these moving averages often act as a dynamic support or resistance levels that move with the price. In an uptrend, a stock will frequently pull back to its 50-day moving average and bounce off it, creating excellent opportunities for traders. Now, the second indicator, which is the Relative Strength Index, RSI. So, what it is a momentum indicator that measures the speed and change of price movements. The scale, it operates on a scale of 0 to 100 with key levels at 30 and 70. Its purpose is to, potentially identify if a stock is overbought or oversold. So its job isn't to show you the trend, but to measure the speed and strength of its price movement. It is plotted on a scale from 0 to 100. So if it is over 70, if it's above 70, so it means it is an overbought zone. So it suggests that the stock has risen too far too fast. It might be due to a pullback or consolidation as momentum becomes overextended. Now there is oversold zone also at below 30. If RSI drops below 30, it suggests that the stock has fallen too far too fast. It might be due to a bounce as a selling pressure becomes exhausted. So you could put RSI into your technical chart and decide what to do. If it's above 70, so don't consider buying it, and if you have already, sell it. And if you have below 30, you could potentially buy it. Now, use indicators for confirmation. Now, this is the most important rule of indicators. You should never ever buy or sell a stock just because indicator gave you a signal. That's a recipe for disaster. Instead, you should use them to confirm and other signals you are seeing. For example, if a stock price pulls back to a major support level and the RSI becomes oversold at the same time, that gives you much more confidence that the stock might bounce from that level. So here are the key takeaways. We discussed about the all the technical indicators which are there, the moving averages and the RSI, the really important two one. And I'll be producing a new course separately for fundamental and technical analysis. So if you want to deep dive into technical analysis and all, so you can check it out over there. Also, we'll be having option trading courses. So if anyone wants to get into FNO or day trading, so you can check that out too. Also, if you're liking the course, please do give us a good rating. Now, how to use always use the indicators for confirmation and not as primary buy or sell signals. So, next up, we have already done the fundamental analysis and technical analysis and complete toolkit. So, uh, we have got these two complete, but there's a complete toolkit remaining. So the fundamental toolkit and the technical toolkit, in our final lecture, we are going to merge them together and create a powerful unified approach to investing, so that you take trades based on both. So your probability of getting right increases a lot. So I'll see you there. Welcome to the final lecture of section 6. We have spent a lot of time learning about two very different approaches to the market. In this lecture, we are going to finally merge them together. We'll learn how to combine the power of fundamental analysis with the timing insights of technical analysis to create a truly robust investing strategy. So, talking about the ultimate synergy, a smarter approach. So, what you can do is for decades, people on the Wall Street have argued which method is superior. The fundamental analysts say that the technicians are just reading the tea leaves, and the technicians say the fundamental are already in the price. I am here to tell you that what is wrong with this debate. The truly successful long term investor doesn't choose one or the other, they use them together. It is a powerful synergy. Fundamental analysis tells you what company to buy, and technical analysis helps you to when to buy. So it answers your what, and this answers your when. Now, talking about the investor's workflow. So, what does this look like in practice? It is a simple two-step workflow. Step one is your fundamental homework. So, fundamental analysis is step one. First, you have to select the company, and you know, uh, this is where you deep dive. We learned about this in section 4 and 5. You find a high quality business with strong competitive advantage and a healthy balance sheet. You create a watch list of these A plus companies. Step 2 is where you put on your technician hat. You go through your watch list, look at the charts for each company, and use your new TA skills to find a smarter and opportune approach to enter your position in the market. Now, scenario is that great company but bad chart. Let's imagine you have done your homework and found a fantastic company. It's a 10 on 10 on your fundamental checklist, but then you pull up the chart and it's in a waterfall decline. The trend is down and it just sliced through a key support level. What should you do? The answer is simple: you do nothing, you don't buy it, right? So you don't have to buy that. You respect that what the chart is telling you, which is that sellers are in complete control right now. You put that great company on your watch list and you patiently wait for your technical trend to improve. Now, you could use technical analysis for better entry points. Once you have identified a fundamentally sound company through your analysis, technical analysis becomes your precision tool for timing your entry. So, we have to see this support level pullbacks, 200-day moving average, RSI oversold signals. So, what does a good entry point look like on a chart? It's when you have a few signals lining up in your favor. Maybe that great company on your watch list has pulled back to a major long term support level, or maybe it's pulled back to its 200-day moving average, where we know is a key level, or maybe the RSI indicator is showing that the stock is deeply oversold. When you can find a fundamentally great company that is also technically opportune price, that's a high probability setup. Now, you could also use technical analysis for risk management. Technical analysis serves as the most just an entry tool. It's a powerful framework for protecting your capital and managing downside risk effectively. So the chart can give you clear line in the sand. You can look at the chart and decide if the stock price falls below a recent critical support level. It might be a sign that investment thesis is wrong and you sell the position to cut your losses short. This is an objective, unemotional way to manage risk. So these are the benefit of stop losses. It limits potential losses on any single position. It removes emotions from exit decisions, and it preserves capital for better opportunities. It also protects against catastrophic drawdowns. Now, fundamental first, always. So, this is the golden rule. I want to end this section with the most important rule of the combined approach. The fundamentals always comes first. Do not let ever a nice looking chart trick you into buying a low quality unprofitable debt written business. That's a losing game. Our strategy is and must always be fundamentally driven first and then technically informed second. So this was all section 6. So, and that's a wrap on technical analysis. You have learned an incredible amount. You know the difference between the two schools of thought. You can read a candlestick chart. You can identify the key architecture of a chart. You understand a couple of basic indicators, and most importantly, you now have a framework combining both methods into cohesive strategy. Okay, so we have covered all the essential knowledge and skills you need. Now, you know how the market works, how to analyze a company, and how to read a chart. In our next big section, it's time to bring it all home. We are going to work on building a personal investment strategy that is designed specifically for you. I'll see you there. Welcome to section 7. Over the past sections, you have built an incredible toolkit. You know how to analyze a business and read a chart. Now it's time to pull it all together into a coherent strategy. We'll start with what is perhaps the most famous and respected investment philosophy of all, value investing. Now, the question comes, what is value investing? So, at its core, value investing is the simple strategy of buying stocks for significantly less than what they are actually worth. Think of it like a bargain hunter. You are not interested in the flashy new items at the front of the store. You are patiently sitting through the clearance rack, looking for a high quality brand that has been marked down for some reason. The famous quote from Warren Buffett, who learned from the father of value of investing, Benjamin Graham, sums it up perfectly. Price is what you pay, value is what you get. So you must remember this core philosophy. Now, talking about the two core concepts, the intrinsic value and the margin of safety. The entire philosophy is built on these two core concepts. The first concept is intrinsic value. This is the idea that any business has a true underlying worth independent of its fluctuating stock price. The second pillar is the margin of safety. This is your protective buffer. This is the principle that you should only buy a stock when its price is well below your calculation of intrinsic value. So, for example, if you get a significant discount like 30% or something or more, so you must buy it. Now, talking about the concept one, which is intrinsic value. Let's talk about this. We all know that stock market can be a crazy emotional place in the short term. A stock's price can jump up and down based on a single news headline. But the actual value of the underlying business doesn't change that quickly. A value investor's core belief is that over the long run, the short term noise cancels out, and a stock's price will eventually gravitate towards its true intrinsic value. Now, talking about the margin of safety. So, the margin of safety is your best friend as an investor. It's your protection against the fact that the future is uncertain and your own analysis might not be perfect. Here's how it works for you. You perform all the fundamental analysis and you calculate that a company is worth about $100 per share. You then look at the market and see if it is trading at $70. The $30 difference is your margin of safety, and yet yes, that's the 30% discount. So it is a buffer that protects you if you made a mistake or if the company stumbles. Now, talking about what does a value investor look for. So what are the practical things a value investor looks for? They hunt for the companies with low valuation metrics, like a low price to earning ratio or a low price to book ratio. So low price to book ratio or means that stock price is attractive compared to the company's net tangible assets and equity base. They want to see a long history of consistent profitability and a rock solid balance sheet with very little debt. Often they find these opportunities in great companies that are facing temporary problem that has scared other investors away. Now, talking about the value investor's mindset is that you must be patient. So, you need to be incredibly patient. It can take a long time for cheap stock to be recognized by the broader market. Second, you have to be contrarian, which means you have to be comfortable buying when everyone else is panicking and selling. And finally, you have to think like a business owner who focuses on long term wealth of the company and not by the daily blips of the stock price. Now, the key takeaways, let's lock in the ideas. We have discussed the core strategy of the value investing centers on purchasing stocks trading below their true worth. Also, the two essential pillars, which is the intrinsic value and margin of safety. So, the investors' characters is that successful value investors are patient, contrarian thinkers who seek fundamentally strong companies experiencing temporary setbacks. So, next up, value investing is a powerful, time-tested strategy, but it is the not the only way to succeed in the market. In our next lecture, we will explore a different but equally powerful philosophy, growth investing. So, I'll see you there. Welcome back. We have just learned about the patient bargain hunting world of the value investor. Now we are going to shift gears completely and explore the fast paced, forward looking world of growth investing. Now let us talk about what is growth investing. Growth investing is a strategy that focuses on buying companies that are growing much faster than the rest of the market. A growth investor isn't necessarily looking for a bargain today. Instead, they are trying to identify the companies that have the potential to become the dominant industry leaders of tomorrow. They are less concerned what a company is worth now and much more concerned what it could be worth in 5 or 10 years. Now, let me tell you about value versus growth, the tale of two investors. So, the value investors ask, is the company cheap right now? Can I buy it below its intrinsic worth? Whereas the growth investors ask, will this be a company be a dominant force in 5 to 10 years? What its market disruption potential is. So this is the classic debate in investing world. A value investors looks at a company and asks for if it is cheap, whereas a growth investors looks at the same company and he asks, is this business going to grow and dominate its industry? A value investor might be a stable, established company like a Coca Cola when its price is reasonable. A growth investor company like Tesla, even though it looks expensive by traditional metrics because they believe in massive future potential. Now, what does a growth investor look for? So, what's a growth investor checklist? The number one thing they look for is explosive revenue growth. They want to see companies that are increasing their sales at a rapid clip. Second, they look for businesses that are creating sales with a large and growing market. Also, they must have some competitive advantages and strong profit margins. Valuation is still important. Now, a common misconception is that growth investors will pay any price for a stock. That's not true. They understand that a great company can be a bad investment if you overpay for it. While they are willing to pay a premium price for a company with premium growth, they still have their limits. They might use more advanced metrics like the PEG ratio, which helps them to figure out if a stock's high PE ratio is justified by its growth rate or not. So, this is also important. Now, talking about the risks of growth investing. This strategy isn't without its risk and they are significant. Growth stocks are famously volatile. Their prices can swing up and down wildly. They're also priced for perfection. The market has very high expectation. So if a company reports earning are that simply good instead of spectacular, the stock can get hammered. And of course, for every Amazon, there are dozens of high growth companies that burned bright and then fizzled out. Now, the growth investor's mindset. To be a successful growth investor, you need the right mindset. You have to be a visionary, someone who can look past the present and identify the big trends that will shape the future. You can absolutely have a high tolerance for risk and able to stomach watching your stocks fall 30 to 40% without panicking. And you don't need a long time horizon because these growth stocks can take many years to fully play out. Now, the key takeaways from this lecture is that growth investors are growth focused. Their critical metrics is strong revenue growth and operations within large, rapidly expanding addressable market. Also, they are willing to pay at a premium pricing, premium valuation for exceptional potential. Valuation discipline still matters. They look at the PEG ratio. Also, the risk profile, it has higher risk and higher volatility than value investing. It requires strong conviction and emotional discipline to navigate market turbulence. So far, we have talked about value and growth, but which are both these strategies focus growing on your initial capital. But what if your main goal isn't growth but income? In our next lecture, we'll dive into the world of dividend investing. So I will see you over there. Welcome back. We have explored value and growth, two strategies focused on making your initial investment grow larger. But there's another major reason people want to invest to create a stream of passive income. In this lecture, we are going to dive into the popular and powerful strategy of the dividend investing strategy. Now, what is a dividend? A dividend is a simply cash payment that a company makes to you, the shareholder. It's the company's way of sharing its profit directly with its owners. This is a crucial concept. With dividend stocks, you have two ways to make money from the stock price going up over time and from these regular, predictable cash payments that are deposited right into your brokerage account. Now, let us understand why do company pay dividends? Why would a company give its cash away instead of using it to grow? The types of company that pay dividends are typically very mature, stable, and consistently profitable businesses. They are so good at what they do that they generate more cash than reasonably reinvest to grow their business further. So, as a reward to their shareholders, they distribute that excess cash. Now, talking about the key dividend metrics, the first is dividend yield, and the second is payout ratio. When you are analyzing dividend stocks, there are two key numbers to know. The first is the dividend yield. This tells you how much income you are getting relative to the stock's price, and it is expressed as a percentage. So, for example, 8,200 stock, approximately $100, paying 246 rupees, approximately $3. So, $100 stocks giving $3 means there is a 3% dividend yield. And talking about the payout ratio, so the percentage of companies' earnings distributed as dividends to shareholders, a payout ratio between 30 to 60% is generally considered healthy and sustainable, indicating the companies retains enough profit for growth while rewarding shareholders too. Now there are two styles of dividend investing. Within dividend investing, these are the two approaches. The first is high yield investing, which is all about maximizing your income right now by buying these stocks with the highest possible yield. The second, and the one I generally recommend for long term success, is dividend growth investing. This approach focuses on buying stellar companies that have a proven multi year track record of increasing their dividend payment every single year. So it's better you invest in these types of companies. You select companies with a proven track record of consistently increasing their dividend payment year after year. Now, talking about the power of dividend growth. Uh, Why is the dividend growth so powerful? Because a company can afford to increase its dividend year after year through good times and bad, is proving you that it is an incredibly strong and durable business. There's a famous list of companies called the dividend aristocrats. These businesses in the S&P 500 that have not just paid but increased their dividend for at least 25 years in a row. The strategy gives you a rising income stream and portfolio of some of the highest qualities companies in the world. Now, talking about reinvesting dividends, the DRIP. You can put this strategy on autopilot and accelerate your returns through something called a DRIP, dividend retirement plan. DRIP means dividend retirement plan. So, what you can do, supercharge your investment returns automatically, reinvesting your dividend payments to purchase additional shares. Nearly every brokers offers this for free. When a company pays you dividend, the DRIP automatically uses that cash to buy more shares of that same stock. This creates a beautiful compounding snowball. The next quarter, you own more shares, you get a bigger dividend payment, which then buys you even more shares, and so on. Now, talking about the dividend investor's mindset. The dividend investor has a specific personality. The primary goal is building a reliable income stream. They are playing the long game. This is not to get rich quick strategy, and they are generally more conservative and risk averse, preferring the steady predictability of a company like Procter and Gamble over the wild ride of high growth tech stock. Now let's sum it up. Dividend investing is an income focused strategy. Focusing on companies that consistently grow their dividend is a great way to build a portfolio of high quality businesses. And by reinvesting those dividends, you can create a powerful compounding machine. It's a perfect strategy for a conservative long term investor. The three strategies we have discussed all involve the hard work of researching and picking individual stocks. But what if there was a simpler, more hands off way to invest successfully? There is. In our next lecture, we'll explore the world of index funds and ETFs. I'll see you there. Welcome back. In the last three lectures, we have explored different strategies for picking individual stocks. That's a fascinating and rewarding process, but it also takes a lot of work. In this lecture, we are going to discuss a strategy that is incredibly simple, incredibly powerful, and requires almost no work at all. This is the strategy of index fund and ETF investing. So, what is an index fund? Let us understand the core of it. You first need to know what a market index is. An index is just like the list of stocks that represent a piece of market. The most famous one is S&P 500. S&P It is S&P 500. This includes the top 500 companies of USA. An index fund uh, is a fund that doesn't have a manager trying to pick the best stocks. Its only job is to automatically buy all the 500 stocks in the S&P 500 in the exact same proportions as the index itself. Its goal is not to beat the market, its goal is to be the market. Now, talking about the haystack analogy, the legendary investor John Bogle, founder of Vanguard, summed up this philosophy perfectly. He said that trying to pick the winning stocks is like searching a tiny needle in a giant haystack. It is incredibly difficult, and most people who try will fail. The index fund strategy says forget the needle, just buy the whole haystack. When you buy one share of S&P 500, you become instantly a part owner of Apple, Microsoft, Amazon, and 497 other giant companies. Now, talking about the power of passive investing, this approach is called passive investing because you are not actively making decisions. You are passively accepting whatever return the market gives you. And here is the amazing, almost unbelievable truth over almost any long term period in history. The vast majority of highly paid, highly educated professional fund managers fail to beat the return of a simple, cheap S&P and 500 index fund. Now let us understand the key advantages of index investing. Why is this strategy so powerful? There are three main reasons. First is the instant diversification. Owning 500 companies is infinitely safer than owning just 5. Second, it costs extremely low, almost zero, because a computer is just buying the list. The management fees are incredibly low, which means more of your money is working for you. And third, the simplicity. It is the definition of simplicity. It is a perfect strategy for someone who doesn't have time or the desire to research individual stocks. Now, you'll often hear this term ETF. So, let us understand what is an ETF. So, the full form of ETF stands for Exchange Traded Funds. An ETF or exchange traded firm is just the modern way that most index funds are packaged. They trade on the stock market all day long, so just like a share of Apple. So when you want to buy an S&P 500 index fund, you'll likely do it buying an ETF with a ticker symbol like SPY. So SPY is for S&P 500, QQQ is for Nasdaq 100, and VT tracks the entire world stock market. Now the index investor's mindset. The successful index fund investor has a certain mindset. They are humble. They admit that they probably can't beat the market, and they are happy to take the market's average return. They are disciplined, and they are hands off. Their job is not to pick the stocks, but to save money consistently every month and invest it, no matter what the market is doing. Right? So they know that the more they mess with their portfolio, the worse their results are going to be. So the key takeaways is that it is a passive strategy. The power comes from its massive diversification and ultra low costs, which are its three core benefits. Also, it has a proven record over the long run. In 15 plus years, they have like performed very well. For example, if you talk about, let's say, Nifty 50, over the last 40 years, it has given 14% annual returns every year. So this is something that is has a proven track record. Also, it is perfect for you. It is an ideal strategy for those seeking a simple, effective, and hands-off approach to building long-term wealth without requiring extensive financial knowledge or constant monitoring. Next up, you could craft your personal strategy, whatever you want, whether it is value investing, growth investing, or dividend investing, or it might be invest index investing, right? So, in the next lecture, we'll be seeing we have covered all the four methods of great pillars of investment strategy: value, growth, dividend, and passive indexing. The final piece of the puzzle is you. In our next lecture, we are going to figure out which of these strategies or what combination of them is perfect fit for your personal situation. And I will see you over there. Welcome to the final and the most important lecture of this section. We have taken a tour of the four major investing strategies. Now it's time to turn the focus inward. In this lecture, we are going to help you design a personal investment strategy that is tailor made for you. So, no one size fits all. There is nothing like that in investing. So, the most important thing is know thyself. I want to be very clear about something. There is no such thing as the single best investment strategy. The best strategy is the one that fits your unique circumstances and, most importantly, the one you can actually stick with when things get tough. To find that strategy, you need to do a belt of self reflection and answer three critical questions. So, ask yourself three critical questions. The first question is that what are your financial goals? First, why are you investing? Your answer to this question will guide everything else. Is your goal aggressive growth because you are in your 20s and saving for a retirement that is decades away? Or you are getting close to retirement and your primary goal is now preserving the wealth you have already built? Or maybe you are already retired and your main goal is generating as much income possible to live on. Each of these goal points, it's a very different approach. Now, the second question is, what is your time horizon? This is simply how long you have until you plan on spending this money. Time is the most powerful tool investor has. So if you have a long time horizon, more than 10 years, you can afford to take on more risk in pursuit of higher returns. So growth oriented strategy might be a good fit. If you have a short time horizon, less than 5 years, you need to be much more conservative. You cannot afford a big market downturn right before you need the cash. Now, the question three is that what is your risk tolerance? And finally, you have to be honest about your own personality. What is your risk? What is your risk tolerance? How would you really truly feel if you woke up tomorrow and see if your portfolio is 30% down? If you know that that would cause you to panic and sell everything at the worst possible time, then a high growth strategy is not for you. You would be much better suited to a more stable, conservative approach. Answering this question honestly is the key creating your a plan you can stick with. Now, how could you match to a strategy? For example, the young accumulator, he is 25 years old and just starting the investment journey. The goal is aggressive growth, building substantial wealth over decades. He has a time horizon of over 40 years and the risk tolerance is high. So the core holding 70 to 80% in low cost, globally diverse index fund like VT or something, and satellite portion dedicated to um, growth stocks. So, since he has a high risk and can weather market storms carefully. Now, the pre retiree, almost 55 years old, approaching the retirement finish line. So, the goal is wealth preservation. He has only 5 to 10 years, and the risk tolerance is moderate. A recommended strategy is that 60% is allocated to index fund, something like that, and 40% is allocated to dividend growth stocks, which will give an income every month, like quarterly or annually. Now, there could be someone, the retiree, who is 70 years old, enjoying retirement life and living off investments. So the goal is maximum income, and time horizon is short to medium, and the risk tolerance is also low. So 60 to 70% here should be into dividend stocks, and 30 to 40% by high quality corporate government bonds, plus a cash reserve for liquidity. This combination provides a dependable income stream while preserving the capital. Now you can combine the strategies also. As you saw in those example, you don't have to be purist and pick one strategy. One of the most effective ways is to build a portfolio using a core and explore approach. The core of your portfolio, maybe 80 or 90%, is invested in a simple, globally diversified index fund ETF. This is your foundation. Then, with the smaller explore portion, you can satisfy your desire to pick individual stocks, whether they be value, growth, or dividend plays. So, with that, we have completed section 7. Let's bring it all home. The perfect investment strategy doesn't exist in book. It exists inside of you. It is a plan that is built around your personal goals, your time horizon, and your tolerance for risk. By combining the strategies we have learned, you can create a personalized and robust plan that will serve you well for decades to come. Now, next up, the real world. You have a written plan. This is a huge accomplishment, but a plan is useless if you don't manage it correctly. In our next section, we are going to learn about the real world practical skills of portfolio and risk management. I'll see you over there. Welcome to section 8. In the last section, you have created a blueprint for your investing strategy. In this section, we are going to learn how to be the construction manager, how to actually build your portfolio, just as importantly, how to protect it. We'll start with the two great pillars of risk management: diversification and asset allocation. So, the oldest rule in investing, you've heard it all: don't put your all eggs in one basket. So, this is the simple, intuitive idea behind diversification. It is without a doubt the most powerful tool you have to control the amount of risk you are taking. And the best part is, it is essentially free. Now, what is diversification? Diversification means spreading your investment across many different assets so that the poor performance of any single investment doesn't wreck your entire portfolio. So, for example, owning 10 different tech stocks isn't good diversification. That's just concentrated risk. When the tech sector has bad year, your portfolio will suffer. True diversification means owning stocks across different sectors like technology, healthcare, and banking, and even across different companies and different sizes. So now let us understand what is asset allocation. Now, asset allocation is related but different concept. This is your big picture strategy. This is how you decide to split your total investment pie between the major asset classes. For most of us, the main slices of the pie are stocks, which are engine for your growth, bonds, which are your stabilizers, and cash, which is your safety cushion. This decision, your asset allocation mix, will have more impact on your long term results than any other choice you make. Now, a simple analogy: building a team. Let's use this analogy to make it clear. Think about it building like a sports team. Your stocks are your flashy strikers. Their job is to score goals and grow your portfolio. Your bonds are your reliable defenders. They won't just win the game on their own, but they are crucial for protecting during market downturn. And cash is your player on the bench, ready and waiting for the perfect opportunity. A team with only strikers would be exciting, but it would lose. You need a balanced team to win. So you must diversify. Also, how they work. So in strong economy and during a recession, your stocks will perform well in a strong economy, but your stocks might fall when there is a recession. So the magic of this is different asset classes don't always move in the same direction. When the economy is booming, your stocks will likely be soaring. But during a recession, when your stocks might be falling, high quality government bond goes up in value, acting as a buffer and cushioning to the blow to your portfolio. This balances smooth out the overall journey and makes it easier for you to stay the course. Now, talking about your personal asset allocation. So, what is the right mix for you? It goes right back to what we have learned in the last section. It depends entirely on your personal goals, your time horizon, and your emotional tolerance for risk. A young and aggressive investor with 40 years until retirement might be 90% in stocks, but a retiree who might need some stable income might be only 40%. So, the key takeaways from this lecture is that diversification, asset allocation, and the foundation. So, theory is valuable, but let's make this practical and actionable. In the next lecture, we'll examine real sample portfolios and learn how to actually construct a balanced portfolio that is right for you, taking everything we have discussed and putting it into practice. Get ready to roll up your sleeves and start building. Welcome back. In the last lecture, we have learned the theory behind asset allocation. Now it's time to roll up our sleeves and put it into practice. We're going to look at some sample portfolios and discuss the single most important maintenance task that you'll need to perform: rebalancing. So, the goal is that a portfolio that lets you sleep at night. As we build these examples, I want you to remember the key takeaways from the last section. The goal is not to find the portfolio with the highest possible return. The goal is to build a portfolio that is perfectly aligned with your personal situation and that lets you sleep well at night, even during a crazy market. Now, here we have sample portfolio one for like a conservative investor. This would be for someone who is nearly or in retirement, or anyone who simply doesn't can't stomach large losses. Their primary goal is to preserve their capital and generate some income. A classic conservative allocation might be 40% in stocks, 50% in safer bonds, and 10% in cash for some liquidity. So, liquid reserves for immediate needs and opportunities, the bonds, high quality government and corporate bonds for income and stability. Also, 40% stocks are invested in blue chip, dividend payers, and low cost index funds for stable growth. The sample portfolio 2, the moderate investor, someone in their 40s or 50s with over 10 to 20 years of time horizon. The goal is finding the sweet spot between growth potential and downside protection. So the classic 60 to 40 portfolio. So 60% in stocks and 40% in bonds. You could also do like this. Now talking about the sample portfolio 3, the aggressive investor. So for someone who is less than 40 and he might be in his 20s or 30s, if a person has a long term horizon for over 20 years and high risk tolerance who can weather market volatility, the primary goal is to maximize long term capital appreciation and wealth building. So, the majority of this would be in stocks and a little bit will be in bonds. So, the sample allocation primarily low cost index funds tracking broad market indices, exposure to both domestic and international markets, optional allocation to individual growth stocks for higher conviction plays, and minimal bonds or cash for liquidity needs. The aggressive stance maximizes growth potential but requires emotional discipline during inevitable market corrections. Now, how to implement this? ETFs. Simple. So, Indian Total Stock Market ETF provides exposure to the broad Indian equity market, capturing the growth of India's economy. Nifty 500 or Nifty 500 ETF. We also have International Stock Market ETF and Total Bond Market ETF. So, using just two or three broad market ETFs can help you build a diversified portfolio than what a billionaire could have built 30 years ago. A popular and effective strategy is the three fund portfolio, which consists of US stock ETF, an international stock ETF, and a bond ETF. Now, so you have built your 60/40 portfolio. You're all set, right? Well, not quite. The market doesn't stand still. Let's say you have a fantastic year where stocks go up by 25% and your bonds stay flat. At the end of the year, your portfolio is no longer 60/40. The stocks have grown so much that it has drifted to a 70/30 allocation. So, without you doing anything, your portfolio has become riskier than you intended. So, basically, drifting happens. So, when you thought that these 60% stocks rose, but they remain still, so now it is 70% stocks and 30% bonds as your wealth has increased. Now, talking about the solution, rebalancing. The solution to this is a simple but powerful discipline called rebalancing. All it means is that on a set schedule, I recommend once a year you look at your portfolio and you sell whatever has done well and buy whatever has done poorly to get back of your original target. In our example, you would sell some of your winning stocks and buy more of your lagging bonds. This is psychologically hard, but it's brilliant automated system for forcing you to sell high and buy low. Now the key takeaways are that let's review the building stocks. Use the sample portfolio as a guide to find an asset allocation that fits you. You can build entirely the portfolio with just few simple ETFs. And more importantly, make a promise to yourself, rebalance once a year to maintain the chosen risk level or if any drift is there. Now managing individual stock risk. So we have our high level portfolio plan, but what if you are using the core and explore strategy and you own individual stocks? In our next lecture, we'll zoom in and discuss how to manage the risk of those individual positions. And I'll see you there. Welcome back. We've built a diversified portfolio and learned how to rebalance it. This manages our overall big picture risk. Now we need to zoom in and talk about how to manage the risk of individual stocks you might own in your Explore portfolio. This is all about controlling your downside. So basically, there are two levels of risk. First is the portfolio risk, and second is the position risk. So portfolio risk we have already covered, managed through asset allocation and diversification across multiple holdings. Now our today's focus is the position risk. Um, this is about ensuring if you made a mistake and pick a stock that turns out to be a disaster, it doesn't blow up your entire account. The goal is to make sure that you can live to invest another day. Now, the rule one, for example, position sizing. Position sizing means deciding how much of your total portfolio capital you will invest in a single stock. This is arguably the most important risk management rule for a stock. So the beginner rule says that never allocate more than 5% of your portfolio into a single stock. It should be diversified like this into many stocks. So for example, for a 10 lakh rupee portfolio, the maximum amount in any one company should not be more than 50,000. This ensures you have room for at least 20 different positions. Now, the maths blow up. Let us see why position sizing is so important and so critical. Imagine investor K gets a hot tip and puts half of their entire portfolio into one stock. The company ends up going bankrupt. Just like that, they have lost 50% of their life savings. They are gone. It could take them a decade or more to recover. Now, let's take the case of investor B. He puts 5% of portfolio in that same stocks. So if the company goes ever bankrupt, there's only a loss of 5%. Painful but recoverable. The other 19 stocks can easily make up for up. So remember uh when $100 stock goes down to $50, you might think that just a 50% loss. But when this has to go again to $100, it will have to take 100% jump. So it will need 100% gain just to break even, right? Just to break even, it will need 100% of the um, thing. Now, rule two, know your uncle point. Before you exit any entry point or you cut losses short, use a stop loss. So this is the second rule, and it is very important to put stop losses. You must decide when to sell before you ever buy. You have to know at what price you will admit you were wrong and get out to protect your capital. The predetermined exit potential is called a stop loss. It is your emergency brake. It takes the emotion out and decision and forces you to be disciplined. Now, how do you set a stop loss? So it is technical, not random. So basically, you just don't pick a random number like 10 or 20%. This is where we use technical analysis skills we learned. A logical and effective place to set your stop loss is just below a significant technical level on this chart. This could be a recent support level or a major long-term moving average. The logic is that if the stocks break below that key level, it's a sign the positive trend is broken and your thesis for buying might be invalid. So you could put your stop loss any of these places. Now the asymmetry of investing. So the magic of stock market lies in the beautiful asymmetry. The odds are stacked in your favor if you play it right. It's not gambling. So the maximum loss on any single stock is 100% if it goes to zero. This is why positioning sizing matters. It limits your exposure. But the maximum gain is unlimited. Stocks can go up to like 200%, 1000% or more. The upside potential is theoretically infinite. The key to long term success is that cut your losers short with disciplined stop losses and let your winners run. One big winner can offset many small losses. Now, the golden rule um, that governs everything: never invest money you cannot afford to lose. The 3 to 5 year rule, um, specifically, never invest money you will need in like next 3 to 5 years, and avoid forced selling. Don't be a forced seller, whether you are panicking or in fear. You are selling at the worst possible time if you need the cash urgently. Also, for emotional stability, when you invest only the surplus capital, you make rational decisions without panicking, even during market downturns. So, the key takeaways from this lecture are: control position risk, use position sizing with 5% rule, never allocate more than 5% of your portfolio into a single stock. Also, predefine your exit, set stop losses, and also set your target. Manage winners and losers, cut your losers short, and let your winners win. Embrace the asymmetry of the market. Also, protect the capital. Never invest money you can't afford to lose. So, next up, we have exit strategy for winners. We have a clear plan for when to sell if we are wrong. But what if we are right? So, when is the right time to sell a winning stock? That's what we will cover in our next lecture using an exit strategy. So, I'll see you over there. Welcome back. In our last lecture, we have created a plan for when to sell a stock. If our thesis is wrong, that's the easy part. In this lecture, we are going to tackle a much more difficult and emotional question: when is the right time to sell a winner? I'm going to be honest with you, selling is the hardest decision in all of our investing. So, knowing when to buying a stock is challenging, knowing when to sell a stock is even more difficult. So, the two powerful emotions make selling particularly hard is that greed make you hold for too long and always hoping for just a bit more gain. Also, you have fear of missing out on future gains can completely paralyze your decision making. So, the worst reason to sell. Let's begin by talking about the absolute worst reason to sell a stock: selling it just because the price has gone up a lot. This is one of the most common mistake beginners make. They'll buy a wonderful company, it will double in value, they'll rush to sell it and lock in their profits. What they don't realize is that greatest companies in the world can go up 10, 50, or even 100 times in value over the long run. Selling your best performers too early is a sure way to limit your long term success. Now, the reason one, the fundamentals have deteriorated. There are competitive threats. the company's growth is slowing down, they are in dangerous debt, and there are some leadership issues. So, any of these reasons, you could sell a stock that now it's over and it's time to sell the stock. Now, reason number two, the second reason, second good reason to sell is when a stock's valuations become completely detached from reality. Sometimes the market just falls in love with a story and the stock price gets pushed to euphoric, unsustainable levels. Even if the underlying company is still fantastic, the price might be so high that there is no realistic way for it to generate a decent return from that point. In these cases, it can be very prudent to trim your position, especially if it has grown to become too large a percentage of your portfolio. Now, talking about the reason three, the third reason is about opportunity cost. You only have a certain amount of capital to invest. Your goal should always be to have it deployed in the best ideas you can find. So, let's say you own a perfectly fine stock that you think might return 8% a year. But now you do some new research and you find that this fantastic company can give return 15% a year. It's a completely logical decision and sell the good idea to free up capital, and you can invest in the new great idea. Now, reason you need money. Um, there could be a personal reason, buying a home, funding education, retirement dreams, etc. etc. So, the key takeaways from this lecture is that the business fundamentals have worsened. When you, then you will sell. The stock has extremely overvalued, and you have reached your financial goal, or you have found a better place to put your money in. Uh, Remember, there should be no bad reason for you to sell. Price movement alone tells you nothing about whether you should continue holding the investment. You must do the fundamental analysis. Now we have completed a framework for buying and selling. Now, the last piece of the puzzle, how do we keep track of everything without driving ourselves crazy? In the final lecture for this section, we'll talk about the right way to track your portfolio and how to do managing your portfolio. So, I'll see you there. Thank you. Welcome to the final lecture of section 8. You have learned all the essential mechanics of building and managing a portfolio. Now we need to talk about how to interact with that portfolio in a healthy, sustainable way. This is all how to stay informed about your investments without becoming obsessed. So, the danger of over monitoring. Modern technology is a double edged sword. It's amazing that we see our portfolio's value update in real time on our phones, but this is also incredibly dangerous. Checking out portfolio constantly is one of the worst thing you can do as an investor. It exposes you to the meaningless random noise of the market's daily swings. This will cause stress, anxiety, and worst of all, it will tempt you to make emotional, short sighted decisions that will almost certainly harm your long term returns. Now, let us talk about what should you track. So, if we are not supposed to watch the daily price action, or what should we be tracking? We need to zoom out and focus on the things that actually matters. On periodic basis, you should be checking three things: your overall portfolio performance, the asset allocation, and individual holding performance. So this is a benchmark, your asset allocation, and if your individual stocks, the fundamental performance of those businesses are good. Now, talking about performance versus your benchmark. So first you need to know if your strategy is on track. The best way to do is to compare your portfolio performance to a relevant benchmark. For most of us, that benchmark would be a simple S&P 500 index fund. Over the long term, your portfolio's return in the same ballpark as the market return. So if your plan is likely working just fine, don't get stressed if you are lagging for a few months or even a year. What matters is the long term trend. Also, your asset allocation. It is the most important thing to monitor your asset allocation. We have talked about this, but it's worth repeating. At least once a year, you need to check if your portfolio has drifted or not. So you could rebalance it. And this is the single most productive check you can do. Also, you could track individual holdings. If you're a stock picker, do you have the responsibility to keep up with your companies? But this doesn't mean watching the stock price, it means watching the business. The perfect time to do this is once a quarter when the company releases its quarterly earnings report. Take 30 minutes to read the highlights. Are the sales still growing? Are the profits are on track? Is the fundamental story you invested in is it still intact? This focuses you on truly what matters. Now, how often you should check? So, let's put this into a simple schedule. For a passive long term investor, there is absolutely no reason to log into your account more than once a month. For deeper review, checking your allocation and earning reports for your companies, doing it once a quarter is perfectly fine. Put it on your calendar and treat it like a calm scheduled meeting, not a frantic and reserve habit. Now, there are tools for effective tracking on your brokerage platform. Either you have a personal spreadsheet or any third party apps like ET Money, Ind Money, Yahoo Finance, etc. So, we have completed section 8 and we have done asset allocation and diversing, position sizing, and how to put stop losses, you how when to exit, a clear exit strategy, and healthy tracking plan. So, this is all for this section. And thank you. I hope you would have understood all the things about investing and you could simply invest. And now it's time. I remember I told you the best day was yesterday and the second best day is today. Start investing. Thank you.